Hello students, welcome to part 2 quick revision of paper 2 corporate and other laws CA Inter. In this part 2 quick revision I am covering 5 topics: management and administration, dividends, accounts, audit and auditors, foreign companies. If you look into the average weightage of these topics, management and administration you can expect 8 marks, dividends you can expect 8 marks, accounts of companies you can expect 6 marks, audit and auditors you can expect 6 to 8 marks, but conservative basis I will allot 6 marks. Foreign companies you can expect 6 marks. So the average weightage of these 5 topics which I am covering in this part 2 marathon is 16 plus 18, 34 marks. So you can expect 34 marks from this part 2 quick revision lecture. And I used handwritten notes up to 122 sections in Companies Act. That means, up to management and administration chapter, I used handwritten notes. And for these 4 topics, dividends, accounts of companies, audit and auditors, foreign company, I used summary notes. So you can look at these summary notes. The same will be uploaded in our website. You can download this document and you can read this document. Our only point I want to tell you is, don't read this document without listening to the lecture, because only upon listening to the lecture you will get a better clarity, you will get maximum benefit from the document. So on what basis I prepared this document, I explained in the video lecture. First thing. Second thing, don't expect a detailed revision in this quick revision lecture, because detailed revision, it is already available in YouTube channel. The duration of the detailed revision is 24 hours, where sufficient number of examples were quoted. But coming to quick revision, this is approximately some 10 to 11 hours. So total part 1, part 2 as well as part 3, the total duration is approximately 10 to 11 hours. So here, much examples were not quoted. Here it is just confirmation of the material facts which you already read. So this will act as a revision guide for you. Getting it? See, total, if you look at the compilation of the document also, approximately, to the best of my knowledge, approximately I compiled a entire Companies Act and entire other laws as well as LLP into some 150 pages. So all these documents will be uploaded in our website, already uploaded in our website. So you can download these documents and you can read this. You can read the content of these documents. Okay. Now stay tuned with the quick revision lecture. All the best for your upcoming exams. Let's continue quick marathon with chapter 7, management and administration, section 88 to section 122. 35 sections are there in this chapter, and I will narrate you a simple story for remembering 35 sections. Trust me. And this chapter is having a weightage of 8 marks. Understood? So this chapter I divided into 2 parts: registers returns part 1, general meeting part 2. Registers returns 88 to 95, general meetings 96 to 122. Registers and returns I further classified into 2 branches: registers, returns. Under registers you can see 3 registers: register of members, register of beneficial owners, register of significant beneficial owners. And these registers are subject to closure. So section numbers continuation: 88 register of members, 89 beneficial owners, 90 significant beneficial owners, and these registers can be closed. Section 91. Now coming to returns, 2 sections you have to remember. One is annual returns, section 92, very popular section for voluntary change of name, for issue of equity shares with the differential rights. Company should not commit any default with respect to section 92, section 137. 92 is final annual returns, 137 is financial statements. Understood? So annual returns section 92, changes in promoter stake 93. Now these registers and returns are available for inspection, and these registers and returns are an evidence under Companies Act 2013. So inspection section 94, evidence section 95. Understood? So part 1, section 88 to 95, very easy to remember. 3 registers: members, beneficial owners, significant beneficial owner. 88, 89, 90. Closure 91. Annual returns 92, changes in promoter stake 93, and all these records are available for inspection, and all these records will act as evidence under Companies Act 2013. So inspection 94, evidence 95. Now coming to general meetings, see, we are having 2 types of general meetings: AGM, EGM. AGM by company section 96, AGM by NCLT 97, EGM by NCLT 98, EGM by company 100. See, first of all, AGM under section 96 is compulsory. If company commits default, any member can file an application with NCLT. NCLT can call for AGM of company or direct a company to call for a general meeting, annual general meeting, that is 97. Next one, AGM by NCLT section 98. So now these three are mandatory. These three meetings are mandatory. Any default in these three meetings attracts punishment under section 99. And continuation section, EGM by company section 100. And general meeting is said to be valid only when it satisfies certain prerequisites. We are having 4 prerequisites: convened, constituted, conducted, concluded. Under these, each and every prerequisite, I categorized various sections. Let's see, prerequisites, 4 parts. How many prerequisites we are having? 4 prerequisites we are having: properly convened, properly constituted, properly conducted, properly concluded. So whether meeting is properly convened or not, for that you need to check 2 things: whether company issued a valid notice calling for general meeting, and that notice, any explanatory statement attached to the notice or not. So properly convened, 2 sections we need to check. One is notice, second one is explanatory statement, 101, 102. Next one, properly constituted. Here we check how many members present at the meeting, and we call it as quorum. Section number 103, continuation. Under properly constituted, first we check quorum. And who will check quorum? Chairman of the meeting will check the quorum. And what is the section number for chairman? 104. While checking quorum, chairman excludes proxy, section 105, and chairman includes representatives of president, governor, representatives of a body corporate. So president, governor, 2 persons, president 1 person, governor 1 person, total 2 persons. So section 112. Understood? Next one, representative of a body corporate. Next section, section 113. So properly convened over, properly constituted over. Next, properly conducted. So at meeting, you will find voting, and the result of voting is resolution. Result of voting is resolution. Now, if you look at voting, 5 sections are there. First one, whose voting rights are restricted, 106. Next one, types of voting. We are having 4 types of voting. Types of voting. How many types of voting we are having? 4 types of voting. The shortcut is SEP square. SEP square. S stands for show of hands, E stands for e-vote, P stands for poll, P stands for postal ballot. Understood? So show of hands 107, e-vote 108, poll 109, postal ballot 110. Are you getting my point? So September is a shortcut. SEP, September. So show of hands, e-voting, poll, postal ballot. Next one, the result of voting is resolution. So under resolution, you need to remember 5 sections, and the cheat code for remembering these 5 sections is CT SAR. CT SAR. Remember the same order. Remember the same order for remembering section numbers. CT SAR. C stands for circulation, T stands for types, S stands for special notice, A stands for resolutions passed at adjourned meeting, R stands for ROC filing. So just continuation section numbers 111, 112, 113 already over here. So next 114 types, 115 special notice, 116 adjourned meeting, 117 ROC filing. Once properly conducted, then next properly concluded. So here you will see minutes of the meeting 118. These minutes is available for inspection. These minutes can be maintained in electronic mode. So inspection 119, electronic mode 120. So once meeting is over, prepare a report of AGM 121, and what are the benefits available to one person company in this chapter, section 122. Getting my point, students? Everyone. So 35 sections in just 2 pages. Remember the story? By default, you can remember section numbers. Now, starting section of this chapter 88, register of members. So applicability. This section is applicable to every company. And every company, since incorporation, has to maintain register of members. If it is a company with the share capital, in that register, yes, you will see that register is in a MGT1 form for members. He may be an equity shareholder, he may be a preference shareholder, but the details of members are entered in the register of members, and the form of register of members is MGT1. And register of debenture holders, register of other security holders, shall be made available in form MGT2. Applicable forms: MGT1 for register of members, MGT2 for register of debenture holders, register of other security holders. Now tell me, for preference shareholders, which form we should maintain as a register of as a register? Answer is MGT1. Equity preference shareholders, one register of members, that is in form MGT1. Clear? Next one, if it is a company without share capital, then that register also includes these particulars. Registers also includes these particulars. And these particulars are common in case of company with share capital also. The difference is, in case of company with share capital, you will find number of shares held by the member. Whereas company without share capital, you will not find particulars regarding number of shares held by the member, because it is a without share capital, right? It is a company without share capital. So if you look at the particulars, member's name, address, if company is a member, holding company is a member of subsidiary company, then SIN details, PAN, nationality, membership start date, end date, and guarantee amount given by the member. So this clause, this particular, you will find only in case of company with without share capital, limited by guarantees. Understood? Next one, other instructions. Any other instructions given by the member to the company regarding service of documents. So all those instructions are incorporated in this registers. Is it clear? Next one, index of names. It is mandatory that companies shall maintain index, but few companies are exempted from maintenance of this index. Index simply, starting page of the register. There you will find the particulars of members, details of the members, who are the members, page number, member name, page number. In that page, you will find complete particulars of the members. Getting my point? Now, index is not mandatory. Index is not required if number of members in a company is less than 50. That means exactly 50, greater than 50. Exactly 50, greater than 50. In these cases, company is required to maintain index of names. Index of names shall be maintained along with register of members. In register of members, first page, index you will find. So now tell me, index required when? Number of members equal to 50 or greater than 50. Index 1 not required if number of members is less than 50. Clear? Next one, whatever register maintained by the depository, we call it as register of beneficial owners. Register of beneficial owners. So now the register maintained by depository is deemed to be company register. So when securities are held in demat form, so the particulars of the security holders you will find in ROBO maintained by depository. Now ROBO maintained by depository is deemed to be company register. Is it clear? Next one, general requirements. Within how many days we should update these registers? So what is the time limit for updation of the registers? The time limit is 7 days. Within 7 days of board approval with respect to allotment of shares, transfer of securities, or changes due to mergers, buyback, forfeitures. So yes, everything should be recorded within 7 days of the happening of an event. Understood? So within 7 days, entries shall be updated. Within 7 days from which date? From the date of event. That event may be board approval. That event may be mergers, buyback, forfeitures. Understood? And where to place these registers? So what is the location of these registers? A registered office. First option, registered office. No doubt, by default, all statutory registers shall be maintained at registered office. But with special resolution, you can maintain these registers at any place in the city, town in which registered office is situated. Suppose in Chennai, yes, we are having registered office. In Chennai, we are having n number of streets. In Hyderabad, we are having n number of streets. So any place in Hyderabad where registered office is situated, any place in Chennai where registered office is situated. Or else you had one more option. By passing special resolution, you can place these registers at any place in India where 1/10 of the total number of members reside. Suppose in our register, we are having 500 members. Out of 500, 50 members are residing in Kolkata. Our registered office is in Chennai, but 50 members are residing at Kolkata. If you want, you can shift all these registers to Kolkata. Since we are having 1/10 of the total number of members strength at Kolkata. Understood? Next one, any judiciary regulatory orders affecting the shares. Yes, those references shall be updated in the register. Suppose a member became insolvent, court issued an order not to transfer his shares. Official SNE will come, so transmit all shares to official SNE. Like that, court gave an order, court gave an instruction. Now record the same in the register of members, in the member details. Wherever we are maintaining the details of the member, just incorporate this court order. Next one, most important point, chance is there. 2 marks MCQ chance is there. So the point is, if promoters of listed company creates any pledge or charge or any lien on the shares held by them, on the securities held by them, those events shall also be recorded within 15 days of such events. So suppose I'm a promoter of a listed company, I'm holding some 10% of share capital in that company. Now, for getting bank loan, I created a pledge on those shares. Which shares? The shares which I held in that listed company. And I'm also a promoter. Now, within 15 days of creation of pledge or creation of charges, the same shall be updated in the register of members. Next one, changes in the status of members must be updated within 7 days. Within 7 days of board approval regarding transfer. Suppose I'm a member, I transferred 100% of my shares to another person. Now I'm a non-member, so status shall be updated. Suppose Mr. X is a member of the company, he got deceased, status shall be updated. Next one, rectification pursuant to legal orders. Section 58, section 59. If you remember section 59, rectification of register of members. Rectification. So any authority passing such orders, yes, subsequent to that orders, registers shall be updated and the same shall be indicated in the registers regarding order reference number. Next one, foreign register. Yes, if a company with share capital having members or debenture holders outside India, it can also maintain a register outside India and we call it as a foreign register. Which formats are same, similar to principal register? Principal register, you all know, register of members MGT1. Now foreign register of members also MGT1. A register of debenture holders MGT2. Now foreign register of debenture holders also MGT2. For members, debenture holders, other security holders residing abroad. And what are the conditions for opening foreign register? First important condition is AOA authorization and immediately intimate to ROC. So these two conditions should be satisfied for opening foreign registers outside India. Sir, within how many days we should intimate to ROC, sir? Within 30 days and form number is MGT3. In MGT3, intimate ROC within 30 days of opening foreign registers and any change in foreign register address particulars, same shall be updated with ROC in same form MGT3 within the same time limit of 30 days. And at registered office, we need to maintain an exact duplicate copy of foreign register and we call it as duplicate register. Now here you will find total 3 registers. Principal register, which contains particulars of members other than members whose particulars are already updated in foreign register. Suppose I am having 1000 members. In foreign register, 50 members details are there. Now in principal register, only 950 members details will be updated. Now exact copy of foreign register, I need to maintain it a registered office. We call it as duplicate register. Now any entry, any updation in foreign register shall be intimated to the person in registered office. So entries must be transmitted within 15 days. So in the foreign register, anytime when an updation is happening, within 15 days of updation, that information shall be transmitted to the registered office and same shall be updated in the duplicate register. So no confusion at all. Total how many registers we are maintaining in case of foreign register? 3. One is principal register at registered office, foreign register abroad. Next one, duplicate register, which is a copy of a foreign register which will be maintained at registered office. And what is the significance of duplicate register? All the particulars in foreign register, you will find those particulars in duplicate register. Foreign register is located outside India, duplicate register is located in India at registered office. So now any entry in the foreign register must be transmitted to the registered office authorized person within 15 days of entry. And who will authenticate the entries in these registers? Company secretary or board authorized person. If company secretary is, if company is having secretary, he will update and he will authenticate the entries, or else any person authorized by the board. And any default in section 88, company punishment 3 lakhs, officer in default punishment to 50,000 rupees. So non-compliance of any provision in section 88 attracts this punishment. 88 over. 89, very small section. See, 89, actually lengthy section only, but I summarized into half page. Just look at this chart carefully. So here, you will find two persons, registered holder, beneficial owner. Suppose I am holding shares in my name, but all the benefits associated with shares are held with you. For example, voting rights you are exercising, dividends you are taking, but you are not a member. I'm the member of company. So that means, I'm a registered holder without any benefits, and you are a beneficial owner, but you are not a registered holder. So Mr. V is a registered holder and Mr. X is a beneficial owner. So the moment this kind of things happen, registered holder has to communicate with company in form MGT4 within 30 days of acquiring ownership without beneficial ownership. And beneficial owner, after obtaining beneficial interest without obtaining registered interest, without obtaining membership interest, then beneficial owner has to communicate same with company in form MGT5 within 30 days of obtaining beneficial interest. And any changes in the registered holder particulars, beneficial owner particulars, same form MGT4, same MGT5 is applicable. And the date of communication, time limit for communication is within 30 days of obtaining ownership without beneficial ownership, within 30 days of obtaining beneficial ownership without legal ownership. See, I'm telling you 2 points, registered owner is nothing but legal owner, beneficial owner is nothing but beneficial owner only, no change. So I'm the legal owner, but I'm not getting any benefits. I'm holding these shares on behalf of you, and you are getting all the benefits, but you are not a legal owner. Now we both have to make communication with company in MGT4, me and you MGT5. So once company receive this information, company has to communicate same with ROC in MGT6 within 30 days. Any default, for registered holder, beneficial owner, the punishment is 50,000 penalty minimum, fixed penalty 50,000. In case of continuing default, 200 per day, maximum 5 lakhs. This punishment is for beneficial owner as well as registered holder. Now for company, if company fails to file MGT6 within 30 days, then for company, for officer in default, 1,000 per day. For company, 1,000 per day during such default continues up to 5 lakhs. Whereas for officer in default, the punishment is up to 2 lakhs. Understood? Now, in case of non-filing of these declarations, beneficial owner cannot exercise those beneficial rights. Of course, company's obligation to pay dividends to registered member is not affected because of this section. So actually, company, under section 123 as well as 127, company is liable to pay dividends to the registered members. Understood? And this section is not applicable to these entities, trust for mutual funds, venture capital funds, SEBI approved funds, government companies which have not defaulted, section 92, section 137. So section 89 exemptions, just remember. Next one, section 90. Investigation of significant beneficial ownership. So far, no question came on this section. Chance is there with respect to limits. A chance is there. So don't take risk. Just look at section 90. I know many of the students will take section 90 choice. But if you look at the screen, 1.5 page, I compiled entire section 90. Without ignoring a single concept, I considered all the points in section 90. You can see now section 90, investigation of significant beneficial ownership. So when a person is called significant beneficial owner, sir, very simple. An individual either alone or together with others, alone plus with others, either directly or indirectly, holding 10% of share capital or holding a 10% of voting rights or carrying 10% of dividend rights. Either of these conditions satisfied, look at the point, 3 points are there. Any point satisfied, then I'll be called significant beneficial owner. What are those 3 points, 3 categories? Me, either directly, that means my individual holding plus my benami holdings, my nominees, for example, my nominees holding put together. Yes, total, we are holding 10% of share capital of the company, or we all having 10% of the voting rights, or we all having 10% of the dividend rights, then section 90 is applicable. According to this section 90, SBO has to communicate with company in form BEN1. And what is the time limit for communication with company? If you are a existing SBO, that means, by the time these rules were notified, you are already a significant beneficial owner. Then within 90 days of commencement of rules, communicate with company about your significant beneficial ownership. No, sir, I'm not existing SBO. After commencement of these rules, I became SBO, sir. Then within 30 days of acquiring, interest, within 30 days of acquiring significant beneficial ownership interest, communicate the same with the company. But there is a small disturbance here. The small confusion point is that the confusion is, suppose within 90 days of commencement of rules, if I get any significant beneficial ownership, then 90 days, after 90 days only, I should communicate with company. So simply by the time of commencement of these rules, if you are already an existing SBO, so within 90 days of commencement of rules, communicate the same with company in BEN 1. After commencement of rules, if you became SBO, then within 30 days of acquiring, communicate with company about your significant beneficial ownership. And this is applicable not only at the time of acquisition, but also at the time of alteration. At the time of alteration also, same is applicable. Once company receive this information, company has to communicate with ROC within BEN 2. Company has to communicate with ROC in form BEN 2, and the time limit is 30 days of receiving declaration from SBO. See, what is the logic behind this section 90? I explained in classroom. In classroom, I took this section for 45 to 50 minutes for discussion. But this is a quick revision. So here I will not teach you any logic. Here I'll just remind you the points you studied. It's like a quick revision capsule. Getting my point, students? So here, I won't teach you any logic. I won't teach you with examples. Just the confirmation, whatever you read. And if you're struggling with revision, this revision lecture will help you. That's it. Next one, maintenance of register. Once company receives this information, company has to update in its register, and the registered form is form BEN 3. So total 3 forms here itself you can see, BEN 1, BEN 2, BEN 3. And this register is available for inspection. Yes, during business hours, at least 2 hours, this register shall be open for inspection, and fees not exceeding 50 rupees. Maximum fees is 50 rupees. Inspection fees. Okay. Now the point is, suppose SBO is not reporting to the company, but company is having a doubt. Yes, this person might be SBO. Last time when he attended to the general meeting, he exercised voting power of 12%, but individually he is holding 4%. But he exercised voting power of 12%. He represented 8% of another person. of voting power of another person. So we had a doubt that that person might be a SBO. Then company has to send a form BEN 4 to that person. So yes, we had a doubt that you are a SBO. So prove that you are not SBO. Now this person is required to file a declaration with company within 30 days of receiving this BEN 4. And if this declaration, if this person fails to file this declaration, or in this declaration he fails to provide satisfactory information, he provided unsatisfactory information, then company within 15 days after expiry of 30 days, or within 15 days after receiving this declaration, company has to file an application with NCLT. So company can request NCLT to pass an order for imposing restrictions on transfer of shares by this person, a suspension of voting rights, suspension of dividend rights. Now NCLT within 60 days it will pass an order imposing restrictions. Within 60 days of receiving application, it can pass an order imposing restrictions on transfer of securities, or imposing, suspending all the rights associated with the shares. Now, this person is having a time limit of 1 year to file an application for removing those restrictions. Suppose if that person failed to file an application for removing instructions, then NCLT can pass an order to transfer all those shares to IEPF. So total 6 steps, all these 6 steps I summarized into the chart. You can see first one, identify SBO, send form. Next one, expect a declaration from that person. If that person is not filing declaration, then file an application with NCLT for imposing restrictions on the transfer. NCLT will pass an order. and after NCLT passing an order, if that person wants to remove those restrictions, if that person is not having a plan to, he's not intended, if that person is not having an intention to carry those shares, to hold those shares with restriction, then that person can file an application with NCLT for removal of restrictions. If no application was filed, then NCLT will pass an order to transfer shares to IEPF. Next one, section 90 is not applicable to the following entities, all government entities, including local authorities, government controlled bodies, mutual funds, real estate investment trusts, and next one, other SEBI regulated entities. Next one, investment vehicles regulated by RBI, IRDA, PF, RDA, PF. Next one, IEPF authority. So for these entities, section 90 is not applicable. That means these entities are not required to file any form with the company. Company is not required to communicate with the ROC. Understood? Everyone. Even shares held by these people also. Next one, default. In case of default of section 90. So here you can see three persons. One is SBO default. Other one is company default. Of course, for company default, officer in default will also get punishment. So in case of SBO's default, 50,000 rupees plus 1,000 per day for continuing failure. So for first default, for the default, first we impose 50,000 rupees punishment, fine. And if that failure is continuing one, if the default is in continuing in nature, then each day of default 1,000 per day will be added, additional fine. It's like and maximum 2 lakhs. For coming to company, 1 lakh rupees plus 500 per day during such contravention continues up to 5 lakhs. And for officer in default, 25,000 rupees plus 200 per day during such contravention continues up to 1 lakh rupees. In case of fraud, any person committing fraud under this section, section 447 punishment will apply. Of course, section 90 is not only applicable to these entities, it is also not applicable to government company where that company is regular in filings of annual returns under section 92, 137, copies of financial statements. Of course, you all know in case of government company, registered member is President of India in case of central government companies. In case of state government companies, governor of the state. But actually they are holding shares on behalf of public only. Yes, government is nothing but representative of people only, ma. It is not possible for us to meet at one place to take decisions collectively. That's why we are sending our representatives to the parliament, to the legislative assembly. They are framing the bills, they are acquiring the securities. That means, all the things they are doing only on behalf of public only. Getting my point, students? That means, public are the beneficial owners. Public is public members, public is a beneficial owner. But it is not possible to apply section 90 to the government companies because public, you can't count, right? 140 crore population is there. Daily some people, n number of persons will die, n number of persons will burn. To avoid confusion, section 90 is not applicable to government company when it is regular in filings under section 92, section 137. Okay. Next one, power to close registers. If company plans to pay dividends, if company plans to issue bonus shares, if company plans to offer right shares, first of all, who are the members of company? That list should be freezed. As you all know, in case of public company, shares are freely transferable. If you take any listed company, every second transfer of shares you can find, during trading hours, every second you will find transfer of shares. Now, who is the member at one particular point of time? It is impossible to decide because shares keep on transferred. Shares, they keep on transferring the shares. So that's why what we do, to get the list of members, so who are eligible to claim dividends, who are eligible to get bonus shares, who are eligible to receive offer of right shares. So first we will freeze registers. If we freeze registers, we can identify the persons to whom we can offer. So to freeze registers is nothing but closing registers. So here we can close register of members, register of debenture holders, register of other security holders, and closure period is at a time 30 days, throughout the year 45 days. At a time, today if you are closing registers, at a time you can close it for 30 days. Throughout the year you can close it for n number of times, but aggregate of all those times, aggregate of all those closures shall not exceed 45 days. Suppose for dividends you closed it for 30 days. Now for a bonus issue you can close it only for 15 days because throughout the year total closure period shall not exceed 45 days. And prior intimation shall be given to the members. At least 7 days prior intimation shall be given to the members so that they can update their status. If they already transferred shares, they can update it. Some new persons acquired shares, or existing members acquired new shares. Existing members acquired other people holdings. Those same shall be updated with the intimation by them. So notice period, at least 7 days before closure, if you are able to serve them a notice, so they can make appropriate action. Understood? And for SEBI list, for listed companies in the process of listing, SEBI can prescribe minimum notice period. It may be less than 7 days. Getting my point, students? So for listed companies in the process of listing, follow SEBI regulations. Next one, manner of closure. Listed companies company in the process of listing, two companies, listed companies in the process of listing, they have to serve notice through advertisement also into newspapers, English newspaper and vernacular newspaper, and also publish the notice on government notified website as well as company website. Of course, this kind of advertisements not required to the private companies. Public notice is not required, because in private company, all transfers, of course, transfers are allowed only with board of directors approval. So that's why private companies are exempted from public notice, whereas listed companies and companies in the process of listing, definitely this public notice is required. Next one, penalty. If you close registers for a period exceeding 30 days at a time, or for a period 45 days throughout the year, then how many extra days you closed, for each day 5,000 rupees is the penalty, and this is maximum up to 1 lakh rupees for company as well as defaulting person, and all these offenses are compoundable in nature. Next one, section 92, annual return. Section 92, annual return. So applicable form, first of all, annual return is applicable to all the companies. Applicability, all companies, including one person company, no doubt at all, including one person company. And what is applicable form? For OPC small company, form is MGT 7A, whereas for other companies, form is MGT 7. Next one, signing. Who will sign this annual return? Director and CS. If company is having CS, then company CS. If company is not having CS, then CS in practice, independent professional. Understood? So go with the outsider. That means practicing company secretary. Suppose if you are a OPC, a director signature is sufficient. Even this benefit is applicable to small companies also. For small companies also, CS signature of CS is not mandatory. For other companies, director as well as CS. Getting my point, students? Next one, contents. If you look at the contents, the annual return, MGT 7A, you will find these contents. So particulars of register office, business activities, holding subsidiary, associate, shareholding patron, members, debenture holders, foreign institutional investor shareholding, promoters, directors, KMP, meetings, board meetings, general meetings, and attendance of the directors, remuneration of the directors, penalties, punishments in the reporting period, and any other certifications you will find in annual return. And coming to certification of annual return, this is in form MGT 8, and this is not applicable to all companies. This is applicable only to 3 companies. One is listed company, second one is companies with paid up share capital 10 crores or more, third one is company with turnover 50 crores or more. Getting my point, students? So this is a quick revision. Once again, I'm reminding you, from this quick revision, don't expect much knowledge. This is just a quick revision. So I expect all students already gone through the syllabus, already studied it twice or thrice. Only those students will get maximum benefit from this. Understood? And one more point, without listening to the lecture, if you go with this PDF document, you won't get maximum benefits. And what is the time limit for filing annual returns? Within 60 days of AGM. Within 60 days of AGM. If AGM is not held, then what is the due date for conducting AGM? Then within 60 days of due date of AGM, along with that furnish the details why AGM was not conducted. Next one, disclosures. So annual return shall be disclosed. A copy, annual report shall be disclosed in the board report. So website link you have to provide in the board report where you can access annual return. That link should be available in this board report. And in case of non-compliance of section 92, penalties. So for company it is 10,000 plus, for continuing default 100 per day, maximum 2 lakhs. Officer in default 10,000 rupees, 100 per day during such default continues up to 50,000. And CS holding COP. If he make any false certification, MGT8, if he makes any false certification in MGT8, he is subject to punishment. The punishment is rupees 2 lakhs. Understood? Next 194, place of keeping and inspection of registers returns. So place, yes, obviously, no doubt, first one, register office. Of course, by passing special resolution, you can shift these registers to any other place in India where 1/10 of the members reside. And these registers shall be preserved for a prescribed period. If it is a register of members, it should be preserved permanently. That means throughout the life of the company, this document shall be preserved. A register of debenture holders, it shall be preserved for 8 years, not from the date of issue of debentures, but from the date of redemption. That means 8 years post redemption, you have to maintain register of debenture holders. And same will apply for foreign registers also. Understood? Of course, if you discontinue foreign register, the particulars shall be updated in principal register, or the particulars may be updated in some other foreign register. Until its discontinuance, yes, they have to be maintained. They shall be maintained. Next one, annual returns. Last 8 years annual returns preserve. Understood? I'm not asking you to preserve since incorporation. I'm asking you preserve last 8 years annual returns. Getting my point, students? And these registers returns are available for inspection during business hours, not less than 2 hours per day. That means at least 2 hours per day should be available for inspection. All these registers and records shall be available for inspection. And what is the fees? For members, debenture holders, there is no fees at all. Whereas for others, maximum fees is 50 rupees. And if anyone want to take any extract, some particular copy, if they want to make a note of the if they want to make a note of particular paragraphs or particular matter, then it is free for members, debenture holders, other security holders. Suppose if they want total copy, no, we will not take notes. We will take entire copy of register, or we will take we will take some 10 pages copies. Then it is subject to the charge. And what is the charge? Rupees 10 per page. Rupees 10 per page. And within 7 days of return request, these copies shall be made available to the requested members. But one point is that this is a last year amendment. The amendment is restricted details. PAN of the member, email of the member, unique identification number like Aadhaar number. Next one, address, mobile number. The personal details of the members are not available for inspection. Are not available for taking extracts, taking copies, because their privacy should not be disturbed. So that's why extracts and copies you can have it, but personal details of the members, you can't access them. And in case of non-compliance, penalties for company as well as officer in default, 1,000 per day, maximum 1 lakh rupee, 1,000 per day, and during contravention period, and it is restricted to 1 lakh rupee. Next one, registers, indices, annual returns maintained by the company will act as an evidence under Companies Act, that is section 95. So part 1 is over. Lengthy, but okay. Next one, part 2, very simple very simple. Section 96 to section 122. Let's see, first one is properly convened, right? Under properly convened, you will see 2 sections, 101 notice, 102 explanatory statement. So notice. And what is the notice period? 21 clear days. So the time gap between date of serving of notice and date of meeting shall be minimum 21 clear days. Here clear means it excludes date of serving notice, date of meeting. Understood? For section 8 companies, it is not 21 days, it is 14 clear days, 14 clear days, but that section 8 company shall not commit any default under section 92 or section 137. And for IFSC public companies, notice period is as per AOA. If AOA is silent, then 101 is applicable. In case of manual post, it is assumed that the notice shall be served after 48 hours of posting. In that case, 21 clear days plus 48 hours. Understood? There is a practical question on the length of the notice. So just go through that practical question. Understood? So if you are sending it by post, then 48 hours shall be excluded from the period. Then you should come to the conclusion whether 21 clear days condition satisfied or not. Next one, if you look at the contents of the notice, you'll find only 4 aspects. TDP, TDPA. Come on, tell me. TDPA. T means time, D for day, P for place, A for agenda. These four particulars shall be incorporated in all the notices: time, day or date, venue, that means place, agenda of the meeting. Next one, to whom we should send notice: members of the company. In case of deceased member, to the legal representative. In case of insolvent member, to the official assignee, and auditors of the company, directors of the company. So these people are eligible to get notice. Understood? And who is having authority to send notice? Of course, board of directors. If any single director is issuing the notice, if any company secretary is issuing notice without board resolution, then that notice is invalid. Of course, that can be ratified by subsequent board meetings, subsequent board resolutions. Understood? Next one, in case of omission of sending the notice, we need to check, company has to prove that whether it is a accidental omission or not. If it is accidental omission, no effect on the proceedings of a general meeting. But if company fails to prove whether it is accidental omission or not, then court will assume it as intentional omission. In case of intentional omission, meeting stands invalid. That means all the proceedings, all the decisions taken at the general meeting stands invalid. And this notice can be sent through email also. But for this, members shall be given one chance once in a year. Members should be given an opportunity to register their mail IDs, to update their mail IDs. And this updation, company has to give chance of one time in a year. And same notice shall be made available in company website also. Now, important point, shorter notice. Shorter notice means, notice served with a period less than 21 clear days. In case of normal companies, less than 14 clear days in case of Section 8 companies. In that case, whether shorter notice valid or not, it depends on the consent of the members. Shorter notice is valid if consent of 95% of the members entitled to vote in case of AGM, if they get consent from these members. So in case of AGM, at least 95% of members who are entitled to vote at that AGM must give consent for shorter notice. And in case of AGM, here company is two types: company with share capital, company without share capital. With the share capital, two conditions to be satisfied. One is majority of members. If you look at the count of members, majority, more than half of the members, and this majority of members shall hold at least 95% of paid up share capital. And they should be entitled, they are entitled to vote at the AGM. If these people give consent, then shorter notice is valid. In case of company without share capital, at least members holding at least 95% of total voting power, and they are entitled to vote at AGM. Getting my point, students? Upon satisfaction of these conditions only, yes, shorter notice is treated as valid, then only proceedings at meeting stands valid, or else proceedings at meeting stands void. Everyone getting my point? Okay, next one, section 102, explanatory statement. See here, decision items are classified into two parts: ordinary business, special business. Ordinary business, we had four items. Adoption of financial statements, including CFS, consolidated financial statements, board report, audit report. Next, appointment of the auditor and fixation of remuneration. Appointment of director in the place of those retiring one, declaration of dividends. These four matters are considered as ordinary business items. For these four ordinary business items, explanatory statement is not required. And other items are treated as special business items. For this, explanatory statement is mandatory. Without explanatory statement, if you give notice with special business, that notice is treated as improper. That means meeting is improperly convened. If meeting is improperly convened, then meeting is not valid. Understood? And the purpose of explanatory statement is to understand meaning, scope, implication of the special business items. Next one, contents of explanatory statement. Nature, in this explanatory statement, yes, it is the duty of the directors, managers, KMP, relatives of the above people, if they had any interest in the proposals, in the special business items, they should disclose their interest. Financial interest or non-financial interest, they should disclose that interest. So complete particulars shall be given in the explanatory statement. Additional information, if any, enabling informed decision making, provide in explanatory statement. Additional disclosures must, suppose, if a company is entering into a contract with another company, and for which members' approval is required, in that case, it is a mandatory to disclose the shareholding of promoters, directors, KMP in that second company if their shareholding, individual shareholding is 2% or more. That means I'm a promoter of this company. I'm also a shareholder of another company. I'm holding 3% share capital in that company. Now, any resolution with respect to approval of contracts with that company, yes, I need to disclose my shareholding in that company. Suppose if my shareholding is 1%, that means less than 2%, no need of these disclosures. Getting my point, students? Disclosure is required only if my holding in the another company is equal to 2% or greater than 2%. That's it. And these documents shall be made available for inspection. You have to mention the time and place of inspecting these documents. Where in explanatory statement. Without disclosure, if you are giving explanatory statement without the disclosures of these directors interest in the proposals, then any benefit, any undisclosed benefit they received, they should compensate the company. In addition to that, defaulting person will get a reward. The reward is 50,000 or 5 times of the benefit he received, whichever is higher. This is the maximum punishment. So the punishment will be up to 50,000 or 5 times of undisclosed benefit received by the defaulting person. So with this 1 or 2 also over. Next 1 or 3, quorum. Expected topic in the upcoming examination. This is the expected topic. So what is a quorum? First of all, quorum is minimum number of members required for a valid meeting. And this is different for different categories of companies. Suppose if you look at private company, quorum is 2 members personally present, or number mentioned in AOA, whichever is higher. It's not lower, whichever is higher. Coming to public company, it depends on number of members in the register of members. If number of members is up to 1000, then the quorum limit is 5 members personally present. If number of members is 1001 to 5000, then applicable quorum is 15 members personally present. If number of members exceeds 5000, that means 5001 and above, then applicable quorum is 30 members personally present. Getting my point? Or count mentioned in AOA, whichever is higher. So MPP means members personally present and who are entitled to vote at meeting. Suppose companies having equity shareholders, companies having preference shareholders, but these preference shareholders are not entitled to vote at the meeting. Now, with respect to quorum, we will check only the number of equity shareholders attended the meeting. And if this number is matching with the statutory limit, then quorum is said to be present. And it is the duty of chairperson to check whether quorum is present in the meeting or not. And the time limit for checking quorum is 30 minutes from the scheduled time. Within 30 minutes of scheduled time, if quorum is not there, then meeting stands adjourned. If that meeting is called because of requisition, then meeting automatically stands cancelled. So in case of EGM, because of requisition or because of requisition filed by requisitionist or EGM called by requisitionist, no quorum, meeting stands cancelled. Other meetings, AGM under section 96, meeting stands adjourned. If nothing is specified, adjournment meeting is to be held on same day, same time, same place next week, same day. Today is Thursday, for example. Same day means Thursday. Same time means, for example, 10 a.m. Same place means at register office, but next week. Or else scheduled time. But here, board of directors have to give a notice at least 3 days before adjournment of the, adjourned meeting. So notice, if it is possible to serve individually, send it individually, or else make an advertisement in 2 newspapers. If quorum is not met in adjourned meeting, then how many members personally present shall constitute quorum? Now here you no need to check quorum. Members personally present will act as a quorum. Getting my point, students? Next one, as per secretarial standard 2. Important, because many times examiner will ask questions from exceptional cases only. So from general provisions already tested, so now he will go in depth. So as per secretarial standard 2, if any person is representing multiple corporates, then count shall also be considered accordingly. Suppose Mr. X is representing A Limited, B Limited, C Limited. All these are members of our company. Now X attended the meeting. Now X is not considered as a count 1. X is not counted as 1. X is counted as 3 because he represented 3 corporates. So count will be 3. But the point is, Suppose X is representing 5 body corporates, for example A, B, C, D, E. Our company, for example Y Limited. In Y Limited, we are having, for example, 7 members. Out of 7 members, 5 members are corporates. 5 members are corporates. All these 5 corporates, appointed X as the representative. Now X attended Y Limited general meeting. Now in Y Limited general meeting, X count will be 5, but quorum is not sufficient. Sir, as per section 103, I'm sorry, yes, as per section 103, quorum is 5 in case of a public limited company with a number of members up to 1000. Yes, I agree. But the point is, for meeting, minimum 2 individuals are required. That's why, even though here X is considered as count 5, extra another individual should be present. So that's what, yes, that's what, at least 2 individuals must be present in the situation. Along with X, some other person should come. Some other member should come. Some other member of the company should come. Or else ask E to appoint ask E to appoint Mr. F as a representative. Now X plus F, that means 2 individuals attended the meeting. Whereas as per section 103, the count is not 2, the count is 5, because if you are representing multiple corporates, count shall be treated as count is also considered accordingly. Next, quorum must be present throughout the meeting. Suppose, in a meeting, 6 items to be discussed. For 4 items, quorum is there. For remaining 2 items, quorum is not there. Now, discussion of remaining 2 items, allowed or not allowed? Not allowed. So, quorum should be present throughout the meeting. And, in case of e-voting, members who already casted their voting rights, who already exercised voting rights through remote e-voting, can attend meeting, and they are counted for the quorum. So, I'm a member of the company. I already exercised my voting power through remote e-voting. So at meeting, I had no voting rights because I already exercised those voting rights. Now, when I attend the meeting, whether I'll be considered, whether I'll be counted or not, answer is counted. And related parties are also counted. Any person having interest in any proposal at the general meeting, yes, that person, of course, that person is not entitled to vote with respect to those resolutions, but that person is eligible to be counted. That person is counted for the purpose of quorum. Next one, in case of postal ballot, section 103 is not applicable. Any resolution passing through postal ballot, any resolution for which voting is conducted through postal ballot, there, meeting is not compulsory. So no need to check section 103. So this is all about section 103, ma. Very simple. Next, 104, chairman of the meeting. So who can be chairman of the meeting? If AOA is silent, then members personally present elect a chairman. One among themselves will act as a chairman. That means, a proxy can't be a chairman, because chairman should be one of the members personally present. So members personally present shall elect one among themselves to act as a chairman by show of hands. Of course, for chairman election, poll can be demanded. If poll is demanded, then chairman who got appointed through show of hands, who got elected through show of hands, will take charge until another person is elected through poll. Some other person is elected through poll. Now, chairman who got elected under show of hands will come out of the position, and chairman elected through poll will take the position. And what are the powers of the chairman? He managed meetings. He maintained decorum throughout the meeting. He is responsible for carrying proceedings properly. He will finalize the minutes. He has authority to make quick decisions, and he should remain impartial. And he's also having one more right. The right is casting vote. If AOA allows, the point is, if AOA allows, that means if AOA is silent, then casting vote benefit is not there. If AOA allows chairperson to vote an extra vote in case of equality of votes, suppose votes in favor equal to votes against, we need ordinary resolution. Ordinary resolution means votes in favor greater than votes against. So in case of equality of votes, if AOA authorizes chairperson to cast this power, chairperson to exercise this power of casting vote, he can cast the vote. If AOA is silent, in case of equality of votes, ordinary resolution is said to be dropped. And this section is exempted to the private companies, provided 2 conditions to be satisfied. One is AOA provides otherwise. That means AOA should specifically mention that section 104 is not applicable to us, and that private company should not make any default in section 92 or section 137. 92 annual return, 137 copies of financial statements. Next one, section 105 proxy. So 105 proxy, right to attend meeting. Proxy is having two rights. Proxy is having two disabilities. One right is right to attend meeting, right to demand poll. Disabilities, he can't speak at meeting. That means he had no power to discuss the matters, decision making matters. And he is also not counted for the purpose of quorum, because in quorum you will find only members personally present. If any member is present through a representative, then he is not counted for the purpose of quorum. Getting my point? Of course, body corporate representatives, president representative, governor representative, they are deemed to be members of the company. They are considered, they are counted for quorum. And proxy benefit is applicable to all companies except to two companies. One is company without share capital and prescribed companies. In future, we may prescribe two or more companies to whom proxy benefit is not applicable. Proxy benefit is not available. So for the time being, only one company proxy benefit is not there. And that too, it is subject to AOA. Suppose if AOA of a company without share capital proposes proxy benefit, then that company can also have a proxy benefit. That company can also have a proxy benefit. But if AOA is silent, then company without share capital cannot have a benefit of appointing proxy. Who can appoint proxy? Any member who satisfy two conditions. One is entitled to attend the meeting, entitled to vote at the meeting. Any member entitled to attend the meeting and entitled to vote at the meeting can appoint proxy. Suppose he is entitled to attend, sir, he is not entitled to vote, sir. He is not entitled to vote because he already exercised voting powers through remote e-voting, sir. Through remote e-voting, then he cannot appoint proxy. Understood? Understood. Suppose I'm a preference shareholder, I'm not entitled to vote at general meeting, sir. Then I cannot exercise proxy benefit. Next, who can be appointed as a proxy? Any person. But for Section 8 companies, a proxy should be a member. That means, a member can appoint another member as a proxy. Whereas other companies, proxy can be a non-member. Even a non-member can be appointed as a proxy. But Section 8 companies, proxy should be a member. A limitation of proxy, max he can represent 50 members. Or he can represent members up to 10% of share capital. Up to 10% of share capital. Suppose each person is holding a 2% share capital. Now proxy can represent 5 persons only. Why? 5 into 2 means 5 times of 2% means 10%. So there 50 is not possible. Either number 50 or paid up share capital 10, whichever is less, that's it. Two conditions to be satisfied. Getting my point, students? Getting my point? Only one condition. It's not one condition. Either you can represent up to 10% of the share capital in terms of share capital, or you can represent 50 members. Getting my point? Suppose each member is holding 1% of the share capital. Now can I represent 50 members? No. Why? 50 times of 1% means 50%. No. Maximum I can represent 10% of the share capital only. Maximum proxy can represent 10% share capital members only. But if any member, suppose I am holding 12% share capital. Now I can have one proxy, but the appointed proxy cannot act as a proxy for other member. The appointed proxy should represent only me at the meeting. That's it. Now, benefit of proxy shall be disclosed in the notice, or else, defaulting person will get a penalty of 5,000 rupees. And applicable form is, proxy form is MGT 11. And time for submitting proxy form is at least 48 hours before meeting. This is not for posting, this is for submission. That means company should receive proxy forms at least 48 hours before meeting. Suppose, during 48 hours before meeting, all those proxy forms received by the company stands invalid. Getting my point? And inspection of proxy is also available. My inspection of proxy forms is also available. But if you want to inspect, you must give prior intimation to the company, that is at least 3 days before meeting. And inspection start time is 24 hours before meeting, before commencement of the meeting. And inspection ends with conclusion of the meeting. Inspection is allowed only during business hours, not midnight times, not after business hours. Only during business hours. Start time 24 hours before commencement of the meeting. End time is conclusion of the meeting. And if any person is circulating a list of persons willing to act as a proxy, and if he is putting a pressure, if he is putting a condition that you can appoint only a specific proxy, that means, we are giving you a list of the persons. Select one person who can act as a proxy. So if we are imposing condition like that, then we will get a reward of 50,000 rupees. That defaulting person will get a penalty of 50,000 rupees. Of course, if any member requests for list of persons willing to act as a proxy, then at the request of member, if we are giving invitations, to appoint specific proxy, then there is no punishment at all. Clear? Proxy also over. Half page, everything I covered. Next one, restrictions on voting rights. Restrictions on voting rights. Okay. Restrictions on voting rights. AOA restricts members' voting rights only in two cases. One is in case of unpaid dues by the member, maybe calls on shares, maybe some other lawful dues. Next one, company exercise lien right on member shares. Then only in these cases, voting rights of the member can be restricted. That too, subject to AOA authorization. Suppose if AOA is silent, then voting rights cannot be restricted. Getting my point, students? Everyone. So next point is joint shareholding. As per regulation 52 in AOA, in case of joint shareholding, senior joint shareholder vote prevails. So senior is not by age factor but by the order of the names in register of members. Suppose A, B, C, D. These four people are joint shareholders and the order is like this: A, B, C, D. Now A gets priority to vote. Suppose A casted vote, B casted vote. Now we consider only A's vote. Suppose only CD attended the meeting. AB not attended the meeting, CD attended the meeting, C casted vote, D casted vote. We will go with C voting. Understood? So the senior person in the order, in terms of names, in terms of order of the names, who is the senior, that person vote will prevail. Next one, once again I'm telling you, other than these grounds, if company is prohibiting any person from voting rights, it is illegal. It is illegal. Note, reallotment of forfeited shares. In case of reallotment of forfeited shares, first time I issued shares, partly paid up shares, person failed to pay call amount, I forfeited shares and I allotted those shares to another person. So reissue and reallotment of forfeited shares. A new allottee cannot vote until all due calls are paid. Only once due calls are paid, a new allottee can vote. Types of voting. Very simple, 4 types of voting we are having. How many? 4. Show of hands, e-voting, poll, postal ballot. Show of hands, generally voting is conducted through show of hands. But if there is any demand for poll or if section 108 is applicable, then show of hands is not applicable. So no demand for poll, e-voting not applicable, then go with show of hands because it saves a lot of time, saves a lot of money. Understood? And the result declaration by the chairman and corresponding entry in the minutes will act as an evidence whether resolution is passed or not. Next, coming to e-voting, it is applicable only to 2 companies. One is all listed companies and companies with 1,000 members. 1,000 members or more. Yes, e-voting is applicable. But there are exemptions. 2 companies are exempted. Nidhi company is exempted and institutional investors, certain institutional investors, SMEs, small medium enterprises. For these entities, even though they are listed, even though they are having 1,000 members, for them e-voting is not mandatory. Next one, poll. Who can demand poll? Specified members can demand poll. Specified persons can demand poll. But the eligibility of the specified persons is they should hold 1/10 of the voting power of the company or paid up share capital of at least 5 lakh rupees. Any condition satisfied, then they can demand for poll. In case of company without share capital, members having 1/10 of the voting power, at least 1/10 of the voting power can demand for poll. In that case, show of hands will be cancelled, poll will be conducted. Next, postal ballot is mandatory for 10 matters. 10 matters, postal ballot is mandatory and postal ballot is not applicable. This is very important. Postal ballot is not applicable if a company is having a number of members up to 200. So for OPC, not applicable. Private limited companies, 200 members are there. Up to 200 members, not required. Similarly for public limited companies also. So, if number of members as per register is up to 200, then postal ballot is not applicable. Even for those 10 matters also. Let's see one by one. In case of e-voting, just by reading this content, you can remember for e-voting, procedure for e-voting. So notice shall be sent, published notice on the company's website as well as agency website, contents of the notice, advertisement in 2 newspapers. Just read this content, you can understand. So remote e-voting, yes, this point is important for MCQ. See, remote e-voting means, what is remote e-voting? You can see here, voting electronically from a location other than meeting venue, even without attending to the meeting. Before meeting day, you can cast vote, you can exercise voting power. That is called remote e-voting. So from your personal, from your residential address, from your business address, without attending general meeting, if you are exercising voting rights through electronic mode, we call it as remote e-voting. And this, for this e-voting, who are eligible to exercise voting rights, eligible members not earlier than 7 days before meeting. So today, for example, today is a meeting, not earlier than 7 days. That means company will impose a cutoff date. As on cutoff date, who are the members of company, they are entitled to vote through electronic mode, electronic means, and that cutoff date shall not be earlier than 7 days before the meeting. Now, in case of remote e-voting, that remote e-voting shall be open for at least 3 days and it shall close at 5 p.m. before the meeting. So today, tomorrow is a meeting, then today up to 5 p.m. remote e-voting shall be enabled. And who will verify the voting count? Who verifies the count of votes polled in favor, in against? So that is scrutinizer, independent person. So board of directors, by passing board resolution, appoints independent professional as scrutinizer. So that means scrutinizer should not be employee of the company. Employee is ineligible to act as a scrutinizer. He must be an external party. Results declaration, votes are counted and consolidated by the scrutinizer. A register of votes is maintained securely until meeting minutes is finalized. Once finalized, all the records are surrendered to chairman of the meeting. So resolution date, when resolution is passed, when resolution is said to be passed, is it on the date of meeting or is it a date of result announcement? The answer is date of meeting, not announcement date, it's date of meeting. So today meeting conducted, for example, tomorrow we are announcing results. Now date of resolution is not tomorrow, date of resolution is today. And resolutions once proposed through e-voting can't be withdrawn. Next one, conditions for poll. So yes, how many members can demand poll? There is no limit on number of members. There is a limit on their holdings. At least 5 lakhs paid up share capital, or at least 1/10 of the voting power they should possess at the time of demanding poll. And who can demand poll? Only members? Are no. Members as well as proxy can demand for poll. Getting my point? Now members plus proxy, whose members didn't attend personally but attended through proxy, consolidated holding 1/10 of the voting power or 5 lakhs paid up share capital, they can demand for poll and the demand is valid. And that demand can be withdrawn at any time. Understood? So time of poll. So when I should conduct poll? You should conduct poll immediately with respect to two matters. One is adjournment of meeting, other one is election of chairman. So if it is election of chairman or if it is a matter of adjournment of meeting, poll shall be conducted immediately. For other matters like, adoption of financial statements, appointment of auditor, appointment of director in the place of retiring one. Understood? So other matters, poll can be conducted within 48 hours of demand of poll. And here also you can see scrutinizer, but the point is generally scrutinizer is appointed by board of directors. But in case of poll, so it's a sudden issue, right? So that's why chairman can appoint a scrutinizer. Here, in case of poll, scrutinizer will be appointed by chairperson. And as you all know, section 102, 107, 109, not applicable to private company if AOA provides otherwise, or else these sections are applicable to private companies. Next one, 110 postal ballot. It's mandatory. Postal ballot is mandatory for 10 matters. So what are those 10 matters? Alteration of MOA objects, alteration of AOA with respect to conversion of companies, public to private, shifting of register office, from one city to another city, from one ROC to another ROC, from one state to another state, alteration of objects specified in prospectus, issue of equity shares with differential rights, variation in rights, buyback of shares, small shareholder director election, sale of undertaking, loans, guarantees. For these 10 matters, postal ballot is compulsory. And postal ballot can be conducted either through post or through remote e-voting. That is nothing but through electronic mode. Two ways possible. Postal ballot can be conducted through post or through electronic mode. Getting my point, students? Next one, it's optional for other business items. But whereas, ordinary business items or matters requiring director auditor attendance, postal ballot is strictly prohibited. So remember these points, ma. Postal ballot is strictly prohibited for these two matters. One is ordinary business items like adoption of financial statements, appointment of auditor, declaration of dividend, appointment of director. Next one, matters requiring director or auditor attendance, for that postal ballot is prohibited. For all other matters, postal ballot, yes, you can opt for postal ballot. Other than these 10 matters, other than these two matters, any other matter if you want to discuss, yes, for example, bonus shares, issue of bonus shares, for example, you can opt for postal ballot also. Next one, here you will find 30 days time limit. 30 days time limit for casting vote through postal ballot. And here also you will find scrutinizer, independent person appointed by board of directors. And you know about postal ballot voting, advertisement in 2 newspapers is compulsory, and that notice of postal ballot includes draft resolution copy, reasons for resolution, instructions for voting. So commencement time, end time, understood. So 30 days time period, everything should be given in the notice. And you know, scrutinizer shall submit the report regarding votes within 7 days of end date of postal ballot voting. So today voting is completed. Then within next 7 days, scrutinizer shall submit a report to the whom? Company. And you know, company declare results declared shall be published on company website. With these types of voting completed. All important time limits, you know, I mentioned here. All important time limits I mentioned here. Getting my point, students? Next one, section 111. So almost, you know, 90% of the concepts over, ma. 10%. Small concepts. In 10 to 15 minutes, I'm going to close this. I'm going to close this chapter. Okay. 111, circulation of members resolution. So here, you know, requisitions shall be signed by the members. How many members, you know, in case of company with share capital, members holding at least 1/10 of the paid up share capital. In case of company without share capital, members holding at least 1/10 of the voting power. So they should sign this copy and they should submit this copy to the company at least 6 weeks before meeting if they want any resolution to be passed at the meeting. No need of resolution, just discussion purpose, then at least 2 weeks before meeting, the copy of a members resolution shall be sent to the company. And you know, and for circulation, you know, for circulation by company among the members, the cost of circulation, yes, requisitionist shall deposit with company, sufficient amount shall be deposited. And you know, yes, company is exempted from circulation if it is proved that, you know, if central government is satisfied that requisition is abusive or defamatory, it is not containing relevant information, it is defamatory against a company, it is abusive. In that case, circulation is not required. And you know, if central government didn't pass an order, no need to circulate like that, then it is the duty of company to circulate that members resolution among other members, or else penalty for default. You know what is the default penalty for default? 25,000 rupees for company, 25,000 rupees for officer in default. Next one, representatives of president governor, representatives of body corporate. 112, 113. Very simple point, ma. They can have representatives and those representatives are deemed to be members of the company. So accordingly, they can be counted for the purpose of quorum. They had a right to speak at the meeting. They had a right to vote under show of hands also. Understood? So very simple point you need to remember under 112, 113. That is, you know, representative of these people are treated as members. So what are the benefits available to the members? Same benefits are also available to the representatives. That's it. 114 types of resolutions. We are having 2 types of resolution. If time is bad, you know, you can expect this section for 5 marks. They will ask you like this, you know, differences between ordinary resolution and special resolution. Sufficient. Okay. So ordinary resolution means votes in favor greater than votes against. Special resolution means votes in favor greater than or equal to 3 times of votes against. If you write this 1 point, you will get 1 mark. Another point is also there, you know, section 101 notice conditions shall be complied. Here also you can see section 101 complaints. Section 101 is nothing but notice. Disclosure of special resolution intention. You know, if company is having an intention to pass any resolution as a special resolution, it is a duty of company to disclose its intention of getting special resolution. So 3 conditions for a special resolution, only 2 conditions for ordinary resolution. And you know, there is a difference between motion and resolution. Motion is nothing but proposal. Once that proposal is adopted, we call it as a resolution. But you know, sometimes few motions will not become resolutions. For example, motion for adjournment of the meeting. So we need adjournment of the meeting. Once that motion is approved, it is not said to be ordinary resolution, it is not said to be special resolution. Getting my point, students? So adoption of a motion is a resolution, but few motions will never become a resolutions. For example, my issue of bonus shares, we need ordinary resolution. Issue of preference shares, we need special resolution. So here first we will introduce a motion. Once it is adopted, yes, resolution is said to be passed. And one important point you need to remember is ordinary business items require OR, special business items require special resolution. Comment, answer is false. Ordinary business items, ordinary resolution, special business items, special resolution is not correct. It depends on Companies Act, it depends on AOA. Suppose if you take issue of bonus shares, it is a special business item. It is a special business item, but OR is sufficient. If you look at equity shares with differential voting rights, it's a special business. OR is sufficient. Getting my point, students? Next, 115. Resolutions requiring special notice. Resolutions requiring special notice. So, special notice concept, ma? Eligibility. So how many members, what is the eligibility criteria for sending a special notice to the company? It's a very simple point, ma. Company will send notice to members. Few members can send a notice to company, we call it as special notice. So special notice is directed by members to the company, but these members should satisfy eligibility criteria. That eligibility criteria is 1% voting power or paid up share capital at least 5 lakhs. Either 1% voting power or paid up share capital 5 lakhs. If the condition is satisfied, they can file special notice with company. And what is the time frame? What is the time limit for deposit of special notice? At least 14 clear days before meeting, but it should not be earlier than 3 months before meeting. And it is a duty of company to serve special notice to all the members at least 7 days before the meeting, either individually under section 101, if it is not possible through advertisement in two newspapers. And instances requiring special notice, two matters, auditor, director. In auditor, director, two aspects are there. For example, removal of existing auditor, appointment of another auditor in the place of retiring auditor. Removal of existing director before end of their tenure, or appointment of a new director in the place of retiring director or removed director. And four matters, but common point is, appointment to removal. Whom? Director, auditor. That's it. And AOA may also specify additional matters. Next one, resolutions passed at adjourned meeting. See, when a resolution is passed at adjourned meeting, what is the effective date of that resolution? Is it a original meeting date or is it a adjournment meeting date? The answer is adjourned meeting date. It's not earlier date, it's adjourned meeting date is the effective date of resolution which was passed at adjourned meeting. Section 117, resolutions agreements to be filed. So what are to be filed with ROC? Resolutions agreements. What are those resolutions agreements? Any list is there? Yes, we had a list. Special resolution, unanimous consent, appointment, reappointment, variation of terms of managing director, class meeting resolution, voluntary winding up, board resolution, prescribed resolutions. But board resolutions with respect to section 179 subsection 3 not applicable to banking companies, NBFCs, housing finance companies. That means, you are a company, banking company, and your board of directors passed a resolution pursuant to section 179 subsection 3. No need to file those resolutions with ROC. Remaining all resolutions, whether you are a banking company or a normal company, you need to file these documents with ROC. What are those documents? Copies of these documents along with that explanatory statement. If it is a special business item, explanatory statement is compulsory and the applicable form is MGT 14. And what is the time limit? Yeah, I forgot to write the time limit, ma. That's what. I forgot to write the time limit. Just wait. Time limit within 30 days. Time limit is within 30 days. So within 30 days, yes, MGT 14 shall be filed with so here itself sufficient. Time within 30 days. Within 30 days, form shall be filed with ROC. Okay, everyone, come on. So this should be your last attempt. I hope, I expect, I pray that this should be your last attempt. That's it. Next one, penalty. In case of delay filing or in case of non-filings, the penalty is for company 10,000. In case of continuing failure, 100 per day, extra fine, additional fine, up to 2 lakhs. And for officer in default, for officer in default, maximum punishment is 50,000 rupees. Next, 118 minutes. Very simple concept. Expected concept. You can expect this concept in your examination. So applicability, minutes applicability, it is applicable to all meetings, members meetings, creditors meetings, director meetings, committee meetings. For all meetings, minutes is applicable. And minutes is also applicable for postal ballot resolutions. And what is the time limit for preparation of the minutes? It is 30 days. Within 30 days of an event, minutes shall be prepared. And minutes shall contain fair and correct summary proceedings, including all the appointments of auditors, directors that happened at the meeting. And minutes of a board or minutes of a committee shall also include additional matters, namely name of the directors present at the meeting, who attended the meeting, name of the directors you need to incorporate, and the directors who dissented or who are not giving their consent to the resolution. So these names shall also be included. The director names shall also be included. Once again, I'm telling you, director casted vote in favor of resolution. No need to include that director name. But a director who is dissenting to the resolution or who is not giving consent to the resolution, who is not voting with respect to the resolution, that director name shall be included in the minutes. And minutes, you can exclude 3 matters, defamatory matters, irrelevant matters, detrimental matters. But who is having authority to decide whether they are defamatory or irrelevant or detrimental? Chairman is having a discretionary powers to exclude these matters. And failure to maintain minutes, any failure, with respect to 118 or rules made there under, punishment is for company 25,000, officer in default 5,000. And in case of tampering of the minutes, the person who is responsible for tampering, he will be sent to jail for 2 years, up to 2 years, and fine minimum 25,000, maximum 1 lakh rupees. Clear? Signing of the minutes. Here you need to check minutes relating to which one. If it is a minutes related to general meeting or postal ballot, then chairman of the meeting or chairman of the company, within 30 days signing should be done. Suppose chairman is not available, then any director authorized by board of directors. Understood? But coming to the board minutes or committee minutes, chairperson of the said meeting, if chairperson of the said meeting is not available, then chairperson of the subsequent board meeting can sign board minutes or committee minutes. That's why here there is no time limit. Time limit of 30 days is there only for general meeting minutes, postal ballot minutes. Next one, preservation of minutes. So how long I should preserve minutes? Permanent throughout the life of the company, you need to maintain, you need to preserve minutes. And in whose custody will keep minutes, sir? Either CS or authorized director. But there is a distinction between place, with respect to place of preservation of minutes. For general meeting minutes, only at register office, whereas for board meeting minutes, either at register office or directors specified, directors agreed place. Next one, 119, very small section. These minutes, I'm talking about 119, I'm talking about minutes of meeting only, minutes of general meeting, minutes of postal ballot. So these minutes shall be maintained at register office and available for inspection for any member during business hours, and every day it shall be open for inspection at least 2 hours, available for inspection. A right to copies. Yes, you can take copies of the minutes, provided per page 10 rupees you need to pay. Maximum 10 rupees fees you need to pay. And within 7 days of your written request, company will dispatch copies. Okay. And if you are planning for, if you want soft copy, no hard copies or soft copy is sufficient, sir. Then, no cost, free of cost, you'll get minutes. But, there is a restriction. The restriction is only past 3 years minutes you will get. Past 3 years minutes you will get. Next one, non-compliance, penalty, if inspection not allowed, copies not provided. In that case, same penalty, in 118 you studied, company 25,000, officer in default 5,000. And what is the role of NCLT in section 119? Suppose, I am requesting for inspection, company is not allowing me for inspection. Then I can file an application with NCLT. NCLT can order for inspection. NCLT can order company to provide requested copies to the requested member. Next, 120, maintenance and inspection of documents in electronic form. So this is applicable for only listed companies as well as company with 1,000 holders or more than that. So for these companies, physical records shall be converted into electronic form within 6 months of the commencement of these rules, commencement of this section. Within 6 months, mandatory convert minutes, convert the documents into electronic form. And the requirements, for electronic form, format, prescribed format, readable, printable, retrievable, and they should be signable digitally, not editable. And whenever updation is happening, at what time, on which date the register got updated, so those particulars shall also be given, those particulars shall also be provided. Suppose I'm sending message to you over WhatsApp, so date of message, time of message, everything will be recorded, right? Similarly here also, whenever a modification, whenever a updation is happening, who updated it, when updation happened, everything should be recorded. And whose responsibility to maintain these documents? MD, CS, company secretary, authorized officer. So next one is section 96, annual general meeting. What is section 96? AGM. Applicable to every company except OPC. Frequency every year one AGM. Every calendar year one AGM. And what is the time limit for AGM? First AGM shall be conducted within 9 months from the closure of first financial year. Subsequent AGM, within 6 months of financial year closure, or within 15 months of previous AGM, whichever is earlier. Of course, subsequent AGM can be extended with the permission of ROC. Maximum extension, maximum extension is 3 months. Once again, I'm telling you, extension of AGM due date is not possible for first AGM. Extension is possible only for subsequent AGMs. And who is having power to grant extension? ROC. And AGM can be conducted on any day except national holiday. It can be commenced between 9 a.m. to 6 p.m. It should be held during business hours. And it should be held at register office or at any place in the city town where register office is located. Coming to unlisted companies, they can have AGM at any place in India provided consent of all members. If all members give consent, then only unlisted company can conduct AGM at any place in India. Need not be a register office, need not be a place or a place in the city town where register office is located. Next one, exemptions. Section 96, exemptions are there with respect to two companies. For government companies, place of AGM, decided by CG. Place of AGM decided by CG, but there should be no default. Next one, for Section 8 companies. For Section 8 companies, time, day, place can be pre-decided by board of directors subject to previous general meeting instructions of the members in the previous general meeting. Next, 9798. So if company makes default under section 96, then any member can request for, any member can make an application with NCLT. Now NCLT is having power to call for the meeting. NCLT can direct the calling of a meeting, issue necessary directions, incidental or ancillary. Even a single person attends the meeting either in member capacity or proxy capacity constitutes quorum. Just wait, single member constitutes quorum. So whether he is a member in personal capacity or a person representing a member, that means proxy, whether attended through proxy or attended in member capacity, shall constitute quorum. Next one, yes, it's a valid meeting. If the meeting is called by NCLT, yes, that meeting is assumed to be valid meeting. 99 any default in 96, 97, 98, the punishment is for company as well as officer in default, 1 lakh rupee standard punishment and additional fine during contravention continuing period. If contravention is continuing in nature, then additional fine of 5,000 per day. 122, section 122, benefits to one person company, 98, 100 to 101, 111, not applicable to OPC. And even for resolutions with respect to 114 types of resolutions, communication of a member of OPC to OPC and this corresponding entry in the minutes is sufficient. Even in case of company having OPC having a single director, the director making a communication. That means, his intention about the resolution and the corresponding entry in the minutes will act as an evidence whether resolution has been passed or not. Generally, meeting requires two persons, right? So that's why, OPC is exempted from meetings. 96 also, if you look at 96, every company except OPC, 96 are not applicable. 96 default, 97 shall apply. If 96 is not applicable, 97 shall also not apply. So that means, generally, from 96 to 122, OPC can have privileges. Understood? But, as per the statute, this is the matter. I summarize the matter that is available in section 122. If OPC is making any default with respect to this chapter, then company as well as defaulting officer will get a fine. How much, sir? 5,000 rupees standard fine, and for continuing failure, 500 per day is an additional fine. 121, only two sections, only two sections. 121, report on AGM. This is not applicable to all companies. This is applicable only to listed companies. And in this report on AGM, you will find these details: time, day, place of AGM, chairman appointment happened or not, number of members attended the meeting so that we can check quorum. Next one, secretarial standards compliance. Next one, businesses transacted at the meeting and their results, any particulars regarding adjournment or postponement of the meeting, and any other relevant points. Understood? Next one, applicable form is MGT 15. Due date for filing this form is 30 days of AGM. Within 30 days of AGM, this form shall be filed, and this form shall be signed by chairman or 2 directors plus company secretary. Out of 2 directors, one should be managing director. If company is having CS, then CS. Obviously, listed companies will have CS, so 2 directors plus CS. Getting my point? In case of default, delay in filing for company, 1 lakh rupees plus 500 per day additional fine, maximum 5 lakhs. Whereas for officer in default, 25,000 rupees. And the number of days delay, for each day 500 rupees additional fine, maximum 1 lakh rupee. Understood? So one point, before I conclude, one point I need to add. See, this is not a detailed revision. This is not a detailed class. This is a quick revision. So in quick revision, you will find the points which you want to revise quickly. That's it. So much examples will not be provided in this quick revision. So at least one example you will find in case of a detailed revision, which is already available in YouTube channel. And more examples you will find in classroom. But here it is a quick revision. Understood? So, listening to this, we didn't understand the content. It's not a correct thing, because here I'm just revising it quickly. It's not examples. It's not about, the number of the examples I'm quoting here. It's just confirmation of the facts which already known to you. So those who are feeling stressed with revisions, by watching this lecture, you can avoid that confusion. AGM by board of directors on suo motu basis, by board of directors based on the requisition filed by requisitionist, or AGM by requisitionist. In case of AGM by requisitionist or AGM because of requisition filed by requisitionist, section 102 is not applicable. Explanatory statement, reasons for resolution not required. Only resolutions to be passed at the meeting, the matter is required. Reasons for resolution not required. Only resolutions are required. Next one, AGM by WOS means wholly owned subsidiary. Wholly owned subsidiary to company incorporated outside India can have AGM at any place, either in India or outside India. And requisition is said to be valid if it is signed by the members who are entitled to vote, and they should possess prescribed capital or prescribed voting power. How much, sir? If it is a company with the share capital, 1/10 of the paid up share capital. If it is a company without share capital, 1/10 of the voting power. And what is the timeline for conducting AGM by board of directors based on requisition? Within 21 days, call for a meeting. Within 45 days of receipt of requisition, conduct a meeting. And if board of directors fails to call meeting within 21 days of receipt of requisition, or fails to conduct meeting within 45 days of receipt of requisition, then requisitionists themselves can conduct AGM by giving at least 21 days prior notice to the members of the company, and that AGM shall be conducted within 3 months of the date of requisition. And if requisitionist is conducting meeting, any reasonable expenses they incurred, they will get reimbursement from company, and company will deduct that amount from director's remuneration. Understood? So with this, all sections I covered with respect to all sections that are there in syllabus. You look at section 93, not there, so I didn't cover it. Okay, so I quickly revised management and administration. Almost I took 1.5 hour, 1 hour 35 minutes. Okay, so with this I conclude this chapter quick revision. Clear? Let's continue our quick revision with chapter 8, declaration and payment of dividend, which is having a weightage of 8 marks in your examination. And in this chapter we are having 5 sections. Very easy to remember. Let me narrate you a story. This chapter starts with declaration of dividends. Any dividend which remains unclaimed or unpaid, transfer those amounts to IEPF along with the rights associated with the shares. In case of default in transferring amounts to IEPF, it attracts punishment. The default attracts punishment. Getting my point, students? Now this is the storyline. So in this storyline we are having 5 sections. Let's see. Declaration section 123, transfer unpaid dividend 124, IEPF 125, rights 126, and punishment for default 127. So like this you have to remember section numbers. Original content is different. Original content now we'll see. So now let's proceed quick revision with a summary notes. So first one is section 123, declaration and payment of dividends. So before declaration and payment of dividends, company has to check whether it is having adequate sources or not. So first of all, what are the sources for declaration of dividend? Current year profits after providing for depreciation, previous financial year's profits which remain undistributed after providing for depreciation, both current year as well as previous year profits which remain undistributed and after providing for depreciation, and last one is money provided by CG or SG under a guarantee. So these are the sources a company is having for declaration and payment of dividends. And the point is, previous year we are in losses, current year we got profits. Now before declaring dividend out of current year profits, first set off previous year losses, unabsorbed depreciation. And in your profits, if these amounts are included, then exclude these amounts. What are those amounts? Unrealized gains, notional gains, revaluation surplus, revaluation reserves. So exclude these amounts and balance from balance amounts, you can declare and you can pay dividends. Next, capital profits are not distributable profits. Next one, transfer to reserves. Companies Act 2013 is not imposing any compulsion on the company to transfer certain portion of profits to reserves. It is up to the company. That means board of directors decides how much portion of profits to be transferred to reserves. Getting my point, students? So Companies Act 2013 is not imposing any obligation on the company regarding transfer of certain portion of profits to reserves. Next one, declaration in case of no profits or inadequacy of profits. So current year we are in losses. In that case, you can declare dividends, you can withdraw amount from previous year's profits. And for such withdrawal, we need to satisfy certain conditions. So what are those conditions? Current year dividend rate shall not exceed average of last 3 years dividends. Last 3 years, how much rate of dividend you declared, average it. That is the maximum rate of dividend for current year. And total amount to be withdrawn from reserves shall not exceed 10% of paid up share capital plus free reserves. So maximum withdrawal is 10% of paid up share capital plus free reserves. And post withdrawal, the balance in free reserves shall not fall below 15% of paid up share capital. So once you withdraw the amount, first set of current year losses against against withdrawn amount. Now that withdrawn amount or maximum rate of dividend, whichever is less, so we can pay, we can declare and we can distribute in the form of dividends. Getting my point, students? See, all the conditions to be satisfied. Condition 1 is talking about a rate of dividend, whereas 2, 3, 4 talks about amount to be withdrawn from previous year profits. And the depreciation we need to provide not as per the discretion of board of directors, but depreciation shall be provided as per schedule 2. So this depreciation shall be provided as per schedule 2. Understood? Next one, depositing dividend amount. So once dividend is declared, it shall be deposited in a separate bank account within 5 days from declaration. So within 5 days from declaration, transfer dividend amount from company's bank account to separate bank account in a scheduled bank. And that amount shall be paid only to the registered shareholders or their orders or bankers. And dividends always must be paid in cash mode only, not in kind. Dividends in kind is prohibited. So through banking channel only, that means through checks, dividend warrants or electronic mode, and dividend must be paid within 30 days of declaration. See, 5 days, 30 days, both are different. 5 days, transferring amounts to separate bank account. 30 days is for payment of dividends to the registered shareholders. Getting my point, students? And it's not 5 plus 30, it's, 30 days includes 5. So declared, for example, dividends declared at this point. From here onwards, within 5 days, transfer amount to separate bank account. And from same time limit, from same deadline, same point, that means, from the date of declaration of dividend, within 30 days, dividend shall be paid. Getting my point, students? So 5 days for transferring amounts to separate bank account, 30 days for payment to the registered shareholders or their orders or bankers. Next one, two companies are prohibited from declaration and payment of dividends. What are those two companies? One company you all know, that is Section 8 company. Section 8 companies are prohibited from declaration and payment of dividends, and the other company is company which has committed default in deposits. Clear? Next one, section 124, provisions related to unpaid dividend account. So once dividend is declared, within 30 days we have to pay those dividends, and any amount left in that separate bank account which remains unclaimed or which remains unpaid, transfer that amount to another separate bank account, and we call that separate bank account as unpaid dividend account. See, this is also a bank account. It's like internal adjustment. So we transfer amount from one account to another bank account, that is, unpaid dividend account, and this transfer should happen within 7 days after expiry of 30 days of date of declaration of dividend. So total, how many days we are having for transferring amounts to unpaid dividend account? 37 days of declaration. In examination, don't write 37 days, because in Act it is not 37 days. It's like 7 days after expiry of 30 days of declaration. Getting my point, students? Now, once you transfer amount to unpaid dividend account, within 90 days of transfer, prepare a statement which contains particulars like name of the members whose dividends remain unpaid or unclaimed, their latest known address which is available with company, and dividend amounts which remain unpaid or unclaimed. Recently, I saw one question in MTP. The question is, only names are included in the statement, address amounts of unpaid dividends are not included. Now that statement valid or invalid? Invalid statement. Getting my point, students? So within 90 days of transferring amount to unpaid dividend account, prepare a statement. And in case of delay in transferring amount to unpaid dividend account, company has to add interest at the rate of 12% per annum for delay period, and this interest shall be distributed among the members proportionate to their dividends. That means this interest will be used only for the benefit of those members whose dividends remain unpaid or unclaimed. Next one, claimants may apply to the company for payment of amount transferred to unpaid dividend account. But the amount lying in unpaid dividend account, once transferred to unpaid dividend account, after 7 years of transferring amount to unpaid dividend account, shall be transferred to IEPF account, which is maintained by IEPF authority, and and whose dividends remain unpaid or unclaimed for 7 consecutive years. Not only his dividends but also his shares shall be transferred to IEPF. Getting my point, students? Unless any dividend is paid or claimed in that period. For example, first year dividend unpaid to that member, for example, member is X. First year, no, he didn't claim dividend. Second year, didn't claim dividend. Third year, didn't claim dividend. Fourth year, he claimed dividend. Now next one, it's not fifth year. Here we need to count it as 1, 2, 3, like that, 7 consecutive years. If any person dividends remain unpaid or unclaimed, now not only the dividends but also his shares shall be transferred to IEPF. Of course, owner of the transferred shares can get back those amounts, dividends as well as shares from IEPF by filing a required documents. And in case of default, that means transferring amounts to unpaid dividend account, transferring amounts to IEPF account, default in preparation of the statement, then those defaults attracts punishment. What is the punishment? For company, punishment is 1 lakh rupees. If it is a continuing failure, additional penalty of 500 per day, maximum 10 lakhs. And officer in default, the penalty is 25,000 rupees. If the failure is continuing one, then additional penalty of 100 per day, maximum 2 lakh rupees. So with this 124 also over. Next one, 125 IEPF. So IEPF here, first 2 points talks about credits as well as debits. So what are the amounts credited to IEPF? and what are the amounts, for what purposes IEPF can utilize those amounts. So utilization of fund, if you observe, 5 points are there. So refund of those amounts to the claimants. Next one, utilizing that amount for promotion of investor education and protection, distribution of discharged amounts to the eligible claimants under section 38, reimbursement of legal expenses for class action suits under section 37, any other incidental purposes are as per the rules. Only for the stated purposes they can utilize the fund. So remember the utilization of fund point, chance is there. Getting a question from this point, chance is there. Next one, refund of amount. For getting refund of the amounts, he need to file an application. A person can claim a refund from the fund for amounts transferred to IEPF even after expiry of 7 years. Because after expiry of 7 years, all unpaid dividend amounts shall be transferred to IEPF. Those amounts you can claim by filing an application with IEPF, not with the company. So here you need to file an application with IEPF authority. Next one, IEPF authority constitution. Here you can see one chairperson you will find, he's a secretary of MCA, ex officio person. Next one, authority also includes persons not exceeding 7 as well as CEO. Next one, central government may provide necessary officers, infrastructure for administering the fund, and the fund accounts to be prepared in the manner prescribed by C&AG. Audit is also taken care by C&AG. So audit of the fund, and finally annual report. So authority prepares annual report detailing its activities for the financial year and submits it to the central government, which lays it before parliament. So this is all about 125. Next one, 126. Right of dividend, right shares and bonus shares to be held in abeyance pending registration of transfer of shares. Suppose Mr. M is a member and he transferred shares to Mr. P. So transfer is pending for registration. Meanwhile, company declared dividends. As per section 123, registered shareholder should get the dividends. Actually, registered shareholder Mr. M, but Mr. M already transferred shares to P, and P is not a registered shareholder because that registration is pending for registration. The transfer is pending for registration. Now, in this case, it's advisable to hold the dividends, to hold right shares, to hold bonus shares for certain time period. Getting my point? So when an instrument of transfer of shares has been delivered for registration, but transfer has not been registered by the company because of few reasons, lawful reasons only. Now, company must transfer dividend related to such shares to unpaid dividend account unless registered holder authorizes the payment to the transferee in writing. Suppose if M is giving instruction to company, pay all the dividends, give all bonus shares to Mr. P, then no need to transfer amounts to unpaid dividend account. Company can pay dividends to Mr. P. Getting my point? Keep in abeyance. Abeyance means hold any offer of rights shares under section 62, that is rights issue of fully paid up bonus shares under section 123 subsection 5 in relation to the unregistered shareholders. See, actually fully paid up bonus shares, it is all about section 63. But section 63, we had one exception to section 123 subsection 5. The bonus can't be paid in lieu of dividends. Bonus shares can't be issued in lieu of dividends. But we had an exception. Company regular in paying dividends. Now, certain portion of profits can be transferred to capital. That means capitalization of profits is possible. That is all about section 63. So to avoid confusion, let me make a small modification here. So this is section 63. Getting it? Next one, 127, punishment for failure to distribute dividends within 30 days. So section 123 is telling that within 30 days of declaration of dividend, the dividend amount shall be paid to the registered shareholders. Suppose if company is not paying dividends within 30 days of declaration, then what will be the consequence? The consequence is Mr. Directors will get a punishment. What is the punishment? Imprisonment up to 2 years and fine minimum 1,000 per day during such default continues. And coming to company has to add interest, simple interest. How much? 18% per annum for delayed period. Getting my point, students? Everyone. Next one. Of course, this punishment will not apply in the following cases. So non-payment of dividend within 30 days because of these reasons, then no punishment. So what are those reasons? Failure due to any law, due to operation of law. Due to operation of law, we are unable to pay dividends. Next one, failure due to directions from shareholder that can't be complied with and same communicated to the shareholder. Suppose shareholder gave an instruction regarding payment of dividend and that instruction we cannot comply. and same has been communicated with the shareholder. Now, default, delay is because of shareholder. So delay is because of shareholder. Here also no punishment. Dispute over right to receive the dividend. Disputed ownership. Next one, dividend adjusted against lawful dues. Suppose a member is holding shares with calls in arrears. Company adjusted dividend amount against calls in arrears. Okay. Any other reason? Not due to company default. Beyond the control of company, like pandemic situation. We posted dividend warrants, but person failed to receive dividend warrants because of lockdown. So these reasons are not due to company default. So yes, non-payment, if it is covered in these 5 cases, then no punishment at all. And particularly this point, it was frequently tested. The second point is frequently tested. So how they will test, shareholder gave instruction to the company, and company complied. Company tried to comply with the instruction but unable to comply with the instruction. Reason, there are some for example, I'll tell you one example. Member gave instruction to pay dividends to his bank account, and that bank account name is mismatch. Name as per our records and name as per bank account, mismatch is there. Now we are unable to comply with the instructions or directions of the member. Now same shall be communicated with that member. Suppose if company fails to communicate the same problem with a shareholder or member, then company, will it get exemption from the punishment? The answer is no, company will get punishment. And what is the punishment? It has to add 18% interest, and for directors the punishment is imprisonment up to 2 years, fine 1,000 per day during such default continues. And for Nidhi companies, if the dividend payable is 100 or less to the person, to a single person, if dividend amount is 100 rupees or less, then section 127 complains how it is possible. Just announce the declaration of dividend in local newspaper and display it on the notice board for at least 3 months of declaration of dividend. So now Nidhi companies are not said to be defaulting companies regarding non-payment of dividends in case any member fails to approach company for the want of dividends. Getting it? So with this, quick revision of dividends completed. So almost approximately I took 16 minutes to complete dividends quick revision. Clear? So once again I'm telling you, this is a quick revision. Here examples you will not find. It's just confirmation of the points which you already studied. For detailed revision, already videos are available in our YouTube channel. So you can go through those video lectures. Getting my point? Now let's continue our discussion with chapter 9, accounts of companies, which is having a weightage of 6 marks in your examination. And here you need to remember some 12 sections. I had a story to remember these sections. Just listen to me first. Just listen to the story first. Every company has to issue financial statements to its members. As a member of the company, I am very much interested in knowing the financial position of the company, financial performance of the company. Now, as a member, I get this information from financial statements. And what is the basis for financial statements? Books of accounts. Financial statements are prepared based on the books of accounts. Understood? And certain companies, along with the financial statements, they need to prepare periodic financial results. And these financial statements are subject to revision either compulsorily or voluntarily. And based on these financial statements, we need to check applicability of 5 things. One is whether NFRA governs that company or not. And NFRA is having a power to prescribe, power to recommend accounting standards to the central government. And based on financial statements, we check applicability of CSR. And based on financial parameters, we check NFRA applicability, CSR applicability, and circulation of the financial statements either through electronic mode or physical mode. Understood? Next one, and regarding your financial parameters only, whether XBRL filing with ROC or normal filing with ROC, we come to know. And based on financial parameters of the company only, we check internal audit, whether internal audit is applicable or not. Now, this is the story, financial statements based on books of accounts. Books of accounts 128, financial statements 129. And financial statements also covers periodic financial results, that is 129A. So revision, compulsory revision of financial statements 130, voluntary revision of financial statements 131. And NFRA governing the company depends on financial parameters prescribed under section 132. NFRA is having power to recommend accounting standards to central government, section 133. Along with financial statements, it's a duty of company to issue board report, to prepare and issue board report to the members, board report 134. Now, based on financial parameters, we need to check applicability of certain things. Already NFRA over. Next one is CSR, corporate social responsibility 135. Circulation of financial statements 136. ROC filings 137. Internal audit 138. Getting it? Now we'll see the summary notes for quick revision. So first of all, basic definitions, books of accounts. Who have to maintain books of accounts? Every company. There is no exception. Every company, whether it is OPC or small, every company has to prepare, every company has to maintain books of accounts. And what comes under books of accounts? Four items comes under books of accounts: receipts and payments, sales and purchases, assets and liabilities, items related to the cost, cost items under section 148. So four items comes under books of accounts. Next one, books and paper. Books and paper includes books of accounts, deeds, vouchers, writing, documents, minutes, registers, paper, electronic form. That means, books of accounts speaks about financial information. Books of accounts contain financial information, whereas books and paper includes financial information as well as non-financial information like deeds, minutes, statutory registers. Next one, financial statements. We had five components in financial statements: balance sheet, profit and loss account, cash flow statement. Of course, cash flow statement is not applicable to OPC, small company, dormant company, and qualifying private companies, startup companies, for example. Next one, statement of changes in equity, explanatory statement annexed to the above documents. So these five components comes under financial statements. Cash flow statement non-applicability is very important. 2 to 3 times same point was tested. Next one, definition of financial year. So definition of financial year, generally financial year ends on 31st March. But if you are a company which is incorporated on or after 1st January, then the first financial year closure date is 31st March of the following financial year. That means following year. Getting it? The transition period of 2 years from the act commencement for aligning financial year to this provision. So if you are following a different financial year, different year as a financial year, so lawmaker is giving you 2 years time period from the commencement of this provision. So within 2 years from the commencement of this provision, you must follow this financial year definition. Next one, if you want to follow different period as a financial year like Jan to December or July to June, so in that case, you have to file an application with central government. So previously it's tribunal, but now authority has been passed to central government. So file an application with central government. If central government grants you permission, then you can follow different period as a financial year. Getting it? Next one, IFSC companies can align their financial year with the holding companies even without tribunal approval or central government approval. So without their approval, without these authorities approval, directly you can follow different period as a financial year. Next one, section 128, books of accounts. So I told you books of accounts had four components: receipts, payments, sales, purchases, assets, liabilities, cost records. Okay, so now maintenance of these books of accounts, everything we will see in section 128. First one, books of accounts must give true and fair view of the company affairs including branches, explain transactions at registered office as well as branch office. So books of accounts must be maintained in such a way that they must exhibit true and fair view. So what actually happened, same shall be recorded, not imaginary figures. And what is the system of accounting? Double entry system of accounting, and books of accounts shall be maintained on accrual basis. For LLP it is different. For LLP cash or accrual, but compulsory for companies it is accrual basis only, and no other option double entry system. Next one, place of keeping books. By default, books to be maintained at register office. Of course, you can maintain books of accounts at some other place, but that some other place should be in India, and it requires board resolution, and same shall be communicated with ROC in form AOC 5 within 7 days of board resolution. Next one, electronic books maintenance. Yes, books of accounts can be maintained in electronic mode, but those books must remain accessible in India. This is the important point. Another important point you can see here, daily backups. So let's see. Audit trail and edit log. From 1st April 23, That means from financial year 23-24 onwards, accounting software must include following features: audit trail transactions, audit trail of transactions, edit log, and audit trail cannot be disabled. Ensure that audit trail cannot be disabled. Next one, retention of records. Books in electronic form must remain in original and accurate form. Branch office information must remain unaltered. So with respect to storage and backup, daily backup. Chance of MCQ is very, very high. Backup should be maintained on daily basis. And you need to provide service provider information to the ROC. So what information of service provider we need to provide? Name of the service provider, IP address, location of the service provider, address, cloud storage, details of control in India for overseas providers. And this storage, everything should be located in India. Backup should be located in India. Suppose if they are maintaining backup outside India, section 128 compliance, section 128 complied or not complied or not complied. So backups, everything should be located in India only. Next one, branch office, proper books to be maintained at branch and summarized returns to be sent to the register office on quarterly basis. And director can inspect these books of accounts. And if you want to inspect subsidiary company books of accounts, board resolution is compulsory. Understood? So subsidiary books of accounts can be inspected only with board resolution. This can't be delegated. Last attempt a question came on this topic, for 5 marks. So the authority to inspect, power to inspect can't be delegated. Preservation period. How long I can preserve books of accounts? You can preserve books of accounts for at least 8 years, 8 preceding financial years. Suppose if you are a company with a age of, age, that means, since incorporation you are 4 years old, for example, then maintain books of accounts for all those 4 years. Understood? And central government can direct for longer preservation during investigations. So during investigation, central government is having a power to prescribe for longer duration, then maintain those books of accounts for the longer duration. Next one, penalty for non-compliance, fine of 50,000 to 5 lakhs for these 4 people, MD, whole-time director in charge of finance, CFO, any other person responsible as designated by the board and who is in default. The default person will get a penalty. Penalty is 50,000 to 5 lakhs. Next one, financial statements. Already told you financial statements are having 5 components, balance sheet, profit and loss account, cash flow statement. Next one, statement showing changes in equity, and last one is notes to accounts. Notes to accounts. See, these financial statements must give a true and fair view of the company affairs. And these financial statements shall be prepared in accordance with accounting standards presented in form schedule 3. Preparation as per accounting standards, presentation as per schedule 3. Getting it? And this schedule 3 accounting standards, these compliance is not applicable to big companies. Big companies means banking, insurance, generation of electricity, and other statutory companies. Next one, financial statements must be laid before AGM by the board of directors for their adoption. In every year, in every AGM, financial statements shall be laid out for approval of the members. Next, if a company is having subsidiary and associates, then company is required to prepare consolidated financial statements, including the figures of, considering the figures of subsidiaries as well as associates. Suppose company is not having a subsidiary, company is having only associate, no need to prepare consolidated financial statements. So companies with subsidiaries, associate, JVs must prepare CFS, and subsidiary financial information must be made available in form AOC 1. So manner of consolidation follows schedule 3 applicable accounting standards. But one company is exempted from preparing CFS even though it is having subsidiary company. What is that company? First of all, that company should be an unlisted company, and it is a subsidiary to another company. Suppose I'm talking about our company C Limited, which is an unlisted company. It is having subsidiary company S Limited, and C Limited is a subsidiary to H Limited. C Limited is a subsidiary to H Limited. Now C Limited is not required to prepare CFS provided C Limited is an unlisted company, and H Limited is ready to prepare CFS considering a C Limited plus S Limited figures. And third condition, C Limited members should give no objection. So that means company should get no objections from the members. 100%. All members should give a NOC to the company. No need to prepare CFS like that. They should give a NOC. Then only C Limited is exempted from preparation and presentation of CFS. Suppose if C Limited is a listed company, then this exemption is not applicable. Suppose C Limited is not having any holding company, then this exemption is not applicable. Getting it? Next one, preparation and audit. Whatever provisions that are applicable to standalone financial statements, same provisions are applicable to consolidated financial statements. And in case of any deviation from AS means accounting standards, any deviation from accounting standards, you need to disclose the deviation along with the reasons and their financial effects. Next one, exemptions by central government. So central government can exempt class of companies from compliance in public interest, either unconditionally or with conditions. Considering public interest, central government can exempt few companies from complying section 129. Defense, for example, defense production companies are not required to prepare, segment reporting. Getting my point? Government companies which are engaged in defense production, for them segment reporting is not applicable, and they should be regular in filings of annual returns under 92, financial statements under section 137. Next one, penalties. Section 129 non-compliance, penalty. These people, MD, whole-time director finance, CFO, other designated person, other person designated by the board, or all directors, they get the punishment of either imprisonment up to 1 year or fine minimum 50,000 to maximum 5 lakhs or both. Next one, listed companies, they need to adhere to SEBI listed obligations disclosure requirements regulations 2015 in addition to section 129. So for listed companies, in addition to section 129, SEBI regulations 2015 shall also apply. This is all about section 129. 129A, periodic financial results. So this is applicable only to the unlisted companies, that too specified class or classes of unlisted companies. So CG may prescribe specified class or classes of unlisted companies to which 129A is applicable. If 129A is applicable to that unlisted company, they need to prepare periodical financial results in a prescribed form. Like for financial statements, we are having schedule 3. Like that, CG may prescribe a form for preparation of periodical financial results and obtain board approval and complete the audit or limited review. Then file a copy with registrar within 30 days of relevant period, 30 days after completion of the relevant period. So objective of this section is to improve corporate governance in unlisted companies. For listed companies, already this is there. As per SEBI regulations, they prepare financial statements on quarterly basis and they submit one copies to stock exchanges also. Next, 130, reopening of accounts on court orders or tribunals orders. Here it is very important to know that, very important to know that company financial statements are prepared fraudulently, or there is some mismanagement, misutilization of resources happen. Either of these two cases, either of these two grounds, if any application is filed by these 5 parties, any of these 5 parties with a court or a tribunal, then court or tribunal will pass an order for reopening of its books of accounts. So who can file an application? Either CG or income tax authorities or SEBI or any other statutory regulatory bodies like regional director, IRDA, for example, any concerned person. So on filing of application, court or tribunal may pass an order for reopening of books of accounts. But what is the basis for reopening of the accounts? Financial statements are prepared fraudulently, or there is some mismanagement in the company operations. So notice requirement, court or tribunal must give notice to the central government, income tax authorities, SEBI, other statutory regulatory bodies, concerned persons before passing the order. And finality of revised accounts. Once accounts are revised, recasted, they will be considered as final. And we had a time limit for reopening of books of accounts. The time limit is 8 financial years. Reopening is possible with respect to books of accounts of preceding 8 financial years, because section 128 is telling the same. Section 128 is telling that company has to maintain preceding 8 financial years books of accounts. That's why reopening is possible to the extent of preceding 8 financial years. Of course, if central government prescribed a longer duration for few companies, then for those few companies, books of accounts can be reopened for the period which was prescribed by central government. Clear? 130 also over. Next, 131, voluntary revision of financial statements or board report. Suppose, board of directors, while preparing current year financial statements, they came to know that previous year financial statements are not as per section 129. Previous year board report is not as per section 134. Then they can file an application with a tribunal for revision of financial statements or board report. This is voluntarily. See here, it's a compulsory because, authority is issuing an order, come on, reopen. But here, you yourself voluntarily filing an application for revision of financial statements or board report. Okay, and here, revision is permitted only up to 3 preceding financial years. How many? 3 preceding financial years. Next one, restrictions. Revision is permissible only once in a financial year. That means we are in the financial year 2024-25, right? So preceding 3 financial years means, 22, 23, 23, 24 and 21, 22. So yes, preceding 3 financial years revision is possible. Now you can revise 21, 22 only once, 22, 23 only once, 23, 24 only once. So beyond one time, second time can I revise same financial statements which I already revised or no. So revision is possible only once in each financial year. That's it. Suppose I want to revise these 3 financial statements in the current year. Can I do it? Yes, you can do it. You can revise preceding 3 years financial statement, yes, in the current year. But the point is, subsequent revision of same financial statements is not at all possible. Next one. Process. For this, file application with tribunal, form NCLT 1, advertise that application at least 14 days before NCLT order hearing, NCLT hearing the case. Tribunal gives notice to central government, IT authorities and others. Tribunal may hear to the auditor of the company. Next, tribunal decision is final. After hearing the representation, tribunal may pass appropriate order which is binding in nature. So yes, suppose, tribunal give approval. Then, revised financial statements. For revised financial statements, convene a general meeting for adoption of revised financial statements. Publish notice in newspaper, in 2 newspapers. And reasons for revision must be disclosed in the board report of relevant financial year. So, current financial year 24-25, we are revising 22-23 financial statements. So what are the reasons for revision and what areas we revise? That information you need to prepare, you need to present in board report of financial year 24-25. Revised statements filings. So revised statements filing shall be done with ROC within 30 days of general meeting where adoption of revised financial statement happen. Next, scope of revisions. Revisions are permitted only with respect to section 129, 134. That's it. So 129 default, 134 default, only these defaults can be rectified through voluntary revision. And central government is having power to prescribe rules with respect to replacement or supplementation of earlier reports or documents, and role of auditor with respect to revised statements, and steps to be taken by the directors with respect to revised financial statements. So next one, keynotes, already told you, certified tribunal orders must be filed with registrar within 30 days. Tribunal considers representation from CG, IT authorities, others, and finally tribunal will give approval for voluntary revision of financial statements board report. Clear? 131 also over. So I'm telling you once again here, I'm quickly revising this summary which is known to you. So if you are facing any problem with revision, this lecture will be helpful to you. No sir, we need some more conceptual clarity. Already video is available in our YouTube channel. Detailed revision is already available. So you can go with that video lecture. No sir, we need a regular class lectures. They are also available. You can have them. Okay. Section 132 is all about NFRA, National Financial Reporting Authority. In this entire chapter, accounts of companies, NFRA, CSR took a lot of space. But the weightage of this chapter is just 6 to 8 marks. Some 1 mark, one question, one theory question, one descriptive question, one multiple choice question will come from this chapter. So, I summarized the NFRA and CSR to the 2 to 3 pages content. So in material content, I included in this summary notes. You can read it once. Getting it? So NFRA, constitution of NFRA, central government is having power to constitute NFRA, and the effective date of constitution of NFRA is 1st October 2018, headquarters New Delhi. So first of all, NFRA applicability, NFRA governs following 5 companies, listed companies either in India or abroad, listing abroad in India or abroad. And unlisted public companies satisfying any of the following three criteria. One is paid up share capital 500 crores or more, turnover 1000 crores or more, loans, debentures, deposits 500 crores or more. And insurance company, banking company, electricity company, by default they are under NFRA surveillance. And referred entities, central government considering public interest, central government notify few entities to which NFRA is applicable. NFRA rules and regulations will apply. And foreign subsidiaries, associates, in case if their income or net worth exceeds 20% of the parent company. Suppose our Indian parent company total turnover is 2000 crores and foreign subsidiary the turnover is, for example, 500 crores. Now consolidated financial statements, total turnover 2000, out of 2000, 25% turnover is getting from foreign subsidiary, so include foreign subsidiary under NFRA surveillance. Getting it? See, all these associate subsidiary companies of these companies, listed companies are also under NFRA surveillance. Now the point is, even though you fails to fulfill this criteria, but still 3 years, for 3 years NFRA rules will apply to you. That means for a period of 3 consecutive years, if you fail to fall within these criteria, then NFRA will not apply to you from the next year onwards. So look at the note point, important MCQ point of view, important. A company or a body corporate other than a company governed under NFRA rules shall continue to be governed by NFRA for a period of 3 years after it ceases to be listed or its criteria falling below stated limits. So even you came out of the criteria, but still for the next 3 years NFRA rules will apply to you. Next one, functions and duties. So NFRA will take all the actions, will take all the steps considering the public interest. So protecting public interest, they will enforce accounting and auditing standards. And their roles also includes, maintaining auditor details with respect to the above companies, recommending standards on auditing, recommending accounting standards to the central government for central government approval, monitoring, enforcing compliance with the standards, both accounting as well as auditing. Next one, publishing findings and taking action against non-compliance, promoting awareness of standards among professionals as well as companies, collaborating with international organizations, suggesting improvements in auditing quality. So these are the duties and functions of NFRA. And if you look at the composition of NFRA, it comprises of chairman, who is an expert, having expertise knowledge in accounts, finance, law, etc. And up to 15 other members, includes representatives from MCA, C&AG, RBI, SEBI, ICAI and other experts also included. These members to NFRA are appointed by CG with conditions ensuring their independence. That means only independent persons will form part of NFRA composition. And NFRA is having a power to investigate companies, power to investigate auditors also, whether auditors are negligent or not, they can investigate. And NFRA is having a quasi judicial power similar to the civil courts. They can summon individuals, they can inspect documents, books, they can enforce compliance, and they can also levy penalties. So imprisonment is not there within the civil powers. So that's why only penalty. And what is the maximum penalty? Individuals 1 lakh rupees to 5 times of the audit fees they received. And with respect to firm of chartered accountants, 5 lakhs to 10 times of the audit fees they received. Understood? And it is also having a power to debar auditors for a tenure, minimum 6 months, maximum 10 years. Next one, NFRA has to prepare has to maintain books of accounts. Audit is taken care by C&AG, and the annual report, audit report, everything shall be submitted to the central government, which will lay down its reports in the parliament yearly once. Understood? So that is all about 132 NFRA. 133 is nothing but accounting standards. Central government central government will notify the accounting standards which are recommended by NFRA. NFRA will get recommendation from ICAI. Understood? So financial statements shall be prepared in accordance with accounting standards. That is all about section 133, small section. Next, 134, board report. So board report, financial statements, board report, etc. That is all about section 134. Let's see, first one is authentication of financial statements. So financial statements must be approved by the board before submission to the auditor. And those approved financial statements shall be signed by chairman if authorized, or two directors. If chairperson is not there or if chairperson is not authorized, then two directors, one must be a managing director. Understood? Next one, CEO, CFO, CS if appointed. If company had these people, then these people have to sign financial statements. And for OPC, approved by one director. Financial statements can be approved by us. One director can be signed by the same director, because OPC minimum one director you will find. Understood? So CEO, CFO, CS, if company is not having these people, then financial statements are not signed by the CEO, CFO, CS, because people are not there, right? So CEO, CFO, CS not there, then company financial statement shall be signed by chairperson if authorized, or two directors, one must be a managing director. Clear? Next one, consolidated financial statements. So consolidated financial statements shall be prepared as per standalone financial statements rules provisions. So what provisions you are following with respect to standalone financial statements? Same. Schedule 3 accounting standards, same are applicable to CFS also. Auditor report is attached to every financial statements, and this must be circulated. Signed copies of financial statements must be circulated along with notes to accounts, along with auditor's report, along with the board report. Next, if you look at the contents of the board report, yes, you can find a website address of annual return, number of board meetings conducted during the reporting period, director responsibility statement, fraud details, section 143 subsection 12, policy on directors appointment and their remuneration, section 178, explanations for qualifications of auditor remarks in their reports, and state of affairs, financial position. Next one, loans, guarantees, investments, related party transactions, conservation of energy, forex. Next one, risk management policy, CSR initiatives, evaluation of board committee performance. This is applicable only for few companies, listed companies and a public company with a prescribed criteria. Only these companies, self-evaluation, formal annual evaluation is applicable. Next one, abridged board report. Abridged board report is applicable for OPC as well as small companies. Next one, director responsibility statement. 6 points you need to remember. So what are the points included in director responsibility statement? Yes, we prepared financial statements by complying accounting standards, and all the policies, judgments we applied, all the policies, accounting policies we applied, they are consistent in nature, and adequate accounting records we are maintaining, and adequate safeguarding measures we have taken for safeguarding the accounting records. Next one, financial statements are prepared based on going concern basis, and adequate internal financial controls are there. Next one, system to ensure compliance with all the applicable laws. So these 6 points to be included in the director responsibility statement. Next one, signing of board reports. Board report shall be signed by chairperson if authorized. If not, signed by two directors, one must be managing director. And for one person company, one director is sufficient. So if you look at the difference between financial statements and board report, financial statements signed by CEO, CFO, CS if appointed, but board report is not signed by CEO, CFO, CS even they are appointed. So board report is signed by chairperson if authorized, or else two directors, one should be managing director. Getting it? So penalty for contravention, for company 3 lakhs penalty, for officer in default 50,000, for non-compliance of section 134. 135 CSR, corporate social responsibility. So almost 3 pages matter. CSR chance is very very high. This time you can expect a question on CSR. Okay, so first of all, CSR activities excludes few activities, and it is very important to remember the list. So that means any amount spent for the benefit of these things, for the benefit of these activities, in these activities, it will not qualify as CSR expenditure. So what are those activities? Normal course of business, political contribution, employee benefits, market sponsorship, statutory obligations like payment of license fees, and performing activities outside India. Any amount spent on the following activities, the expenditure is not a qualified CSR expenditure. And for CSR activities, of course, you can incur some administrative overheads which shall not exceed 5% of CSR amount. Next one, net profit shall be calculated according to section 198, and this net profit excludes overseas branch profits, because those profits you got outside India. And if you received any dividends from the companies which are already covered under section 135, that means companies which are already complying section 135 CSR, and dividend amount received from that companies, dividend amounts are excluded from the profit for determining CSR expenditure. You all know CSR expenditure, it is a minimum 2% of 2% of net profits of the company, average of 2% of preceding, I'm sorry, 3 years, 3 preceding years net profits, average it on that, apply 2%. That is the CSR expenditure. The CSR amount, amount to be spent on CSR activities. Out of that 5%, out of the CSR amount, 5% can be utilized for administrative overheads. Getting it? Now, while calculating these profits, two amounts are excluded. That is profit which you got from overseas branches, and the dividends which you got from the companies, not all companies, but from the companies which are already covered under section 135. Getting it? Ongoing project means, this is a project for a duration of more than 1 year, but not exceeding 3 years. Excluding commencement year, that means including commencement year. Today, for example, this year I started one project, so this year plus 3 years, this year plus 3 years. Getting it? Or extended projects with board approval, but maximum, minimum duration is more than 1 year, then only we can call them as ongoing projects. And CSR is applicable to the companies whose net worth is 500 crores or more, or turnover 1000 crores or more, or net profit 5 crores or more. Next one, exception for CSR committee. No need to constitute CSR committee if CSR spending is less than or equal to 50 lakhs. So CSR expenditure, CSR eligible expenditure, if that amount is 50 lakhs or less than 50 lakhs, CSR committee is not required. First of all, CSR committee, in CSR committee, how many directors should be there in the CSR committee? First of all, in CSR committee, you'll find directors. And how many, sir? General requirement, minimum 3 directors. Out of 3, 1 should be independent director. In case of no requirement of independent directors, CSR requirement, CSR committee composition, you'll find a minimum 2 directors. For private companies, minimum 2 directors you will find in CSR committee. And in case of foreign company, at least 2 persons, and 1 should be nominated by the company as per section 380 subsection 1 clause D. That means authorized representative. And what are the duties of CSR committee? The duties are FRM, F formulate or recommend, M monitor. Formulate policy, recommend expenditure, and monitor the CSR activities. Next one, create annual action plan. CSR committee is also responsible for creating annual action plan. Includes what are the projects we are going to take up under CSR activities, execution methods, fund usage, monitoring mechanisms, as well as impact assessment. A separate point is there on impact assessment. We'll see it there. Next one, duties of board. So what is the role of board of directors under section 135? See, whatever policy is framed by CSR committee, that policy must be approved by board of directors, and board of directors must disclose the policy in board report as well as company's website. Board of directors are responsible for ensuring compliance of section 135. And CSR expenditure, how much? At least 2% of average net profits from the preceding 3 financial years. And these expenditures shall be spent first, in the local areas. Priority shall be given to the local areas surrounding regions of the operations. Administrative overheads, yes, maximum 5% of CSR expenditure. That means, 100 rupees CSR expenditure is there. Out of 100, 95 rupees, minimum 95 rupees should go to the benefit of public. 5 rupees you can spend it on, maximum 5 rupees you can spend it on administrative overheads for carrying CSR activities. For newly incorporated companies, 3 years time period not yet elapsed, then take 2 years or 1 year profit, spend 2% of those profits. Surplus arising out of CSR activities. Any surplus that is arising out of CSR activities shall not form part of business profits and shall be utilized for same CSR projects. Getting it? Transfer unspent CSR amount to be used as per CSR policy and action plan, and transfer to a schedule 7 fund within 6 months of the financial year end. So this amount, these points I'll discuss with you with respect to unspent CSR amounts. Unspent CSR amounts, unspent CSR amounts, either they shall be transferred to unspent CSR account in case of ongoing projects. If it is not ongoing projects, then within 6 months of the closure of financial year and transfer that amount, unspent CSR amount, to a fund notified in Schedule 7. Excess CSR spending, 2% is a 2% is the minimum spending. For example, if you spend 4%, then whatever excess you spend, the 2%, or suppose 2% you spend 5%. Now how much excess you spend? 3%. The excess amount which you spent in the current year can be carried to the next 3 financial years, where you can claim set off. So surplus from CSR activities cannot be included in this set off amount. So any amount surplus you are getting from CSR activities, those amounts you can't claim set off. First of all, set off principle is not applicable to the surplus. Surplus amount shall be utilized for CSR objectives. Approval via board resolution is also mandatory. Next one, failure to spend minimum CSR amount. Yes, here it is the point, ma. So yes, we call them as unspent CSR amounts. For non-ongoing projects, transfer those amounts within 6 months from the closure of financial year. In case of ongoing projects, within 30 days of closure of financial year, transfer amount to a separate bank account, name it as unspent CSR account, and this amount shall be utilized within 3 years. Suppose 3 years completed, unspent amount is still pending, unspent, some amount is lying in unspent CSR bank account, sir. Then transfer it to a Schedule 7 fund within 30 days after expiry of 3 years. And any capital asset arising due to CSR activities, company shall not possess those assets. Company shall transfer those capital assets to Section 8 company or registered public trust, registered society which is having CSR registration. Understood. So our beneficiaries of the project, like self-help groups, so capital assets shall be transferred to these people or to any public authority. So capital assets must not be held by the company. Those assets shall be transferred to these persons. Capital assets created before 2021, that is before commencement of these rules, then company must comply with these requirements within 180 days of commencement of these rules. Of course, if you want extension is also possible, 90 days. That means total 180 plus 90, 270 days time period is there for transferring capital assets to the aforementioned persons after commencement of these rules. CSR implementation, yes, company can directly spend CSR amounts. Company can directly spend CSR amounts, or company can spend CSR amounts through specified entities, namely connected charitable entities, government established entities, statutory entities, independent charitable entities with at least 3 years of experience, and they should possess a certificate which is issued by central government. Next one, CSR reporting and impact assessment. CSR committee will take care of reporting activities, and this report shall form part of board report. Reporting formats, Annexure 1, Annexure 2 is there. Annexure 1 for, financial year commencing before 1st April 2020, and Annexure 2 is for financial years commencing on or after 1st April 2020. Impact assessment important, ma. Impact assessment is applicable not to all companies, but to the companies which is having CSR obligation of 10 crores or more. See, if CSR obligation is 50 lakhs, CSR committee is not applicable, impact assessment is not applicable. If CSR obligation is 10 crores, 11 crores, 12 crores, then impact assessment is compulsory. It's like an audit, ma. Here we check how far public is benefited. Because of our CSR activities. Getting it, ma? And applicable for the projects with an outlay of 1 crore or more. Impact assessment shall also be carried to the projects where 1 crore obligation is there and completed 1 year earlier. So impact assessment is applicable to the companies where CSR obligation is of 10 crores or more in the last 3 financial years. Independent agency will carry impact assessment. Employee can't carry impact assessment, only independent agency. Next one, CSR booking for impact assessment. Expenditure for impact assessment is maximum 2% of total CSR expenditure or 50 lakhs. Suppose I am having obligation, CSR obligation of 100 crores. Now 2 crores or 2% of 100 crores, 2 crores or 50 lakhs, whichever is higher, I can spend it for CSR impact assessment. The next one is penal provisions for non-compliance of section 135. So here, twice the amount required to be transferred to the fund specified in Schedule 7 or unspent CSR account or rupees 1 crore, whichever is less. So in case of non-compliance with respect to unspent CSR amounts, so the punishment is twice the amount to be transferred to Schedule 7 or unspent CSR account with respect to ongoing projects or 1 crore. So up to here it is one limit ma. 2 times of the amount pending or 1 crore whichever is less. Defaulting officer, 1/10 of the amount required to be transferred to fund or unspent CSR account or 2 lakhs, whichever is less. So this is the penal provision. Suppose, some 30 lakh rupees I need to transfer to unspent CSR account within 30 days of closure of financial year, but I failed to transfer. Then twice of 30 lakhs means how much? 2 times of 30 lakhs means 60 lakhs. 60 lakhs or 1 crore, whichever is less means 60 lakhs, for company. Whereas for defaulting officer, 30 lakhs into 1 by 10, that is 3 lakhs. 3 lakhs or 2 lakhs statutory limit, whichever is less means 2 lakhs. So 2 lakhs is for defaulting officer. So that is all about section 135. Important material points I discussed with you. I revised with you. In fact, it's not a discussion, it's a revision. Next one, 136, rights of members to the copies of audited financial statements. So it is the duty of company to circulate audited financial statements along with audit report, board report. Understood? So circulate these documents among the members. So documents to be circulated, financial statements, auditor report, other required annexures, attachments, prescribed documents, separate financial statements of subsidiaries if requested by the member. Audited or unaudited. In India, audit is compulsory. Outside India, audit, few countries may follow audit procedures, may not follow audit procedures. So that means few financial statements of foreign subsidiaries may be unaudited. Next one, so with whom we need to circulate, sir? Who are the recipients, sir? Every member of the company, trustee for debenture holders, other entitled person. These people should get financial statements, board report, audit report under section 136. And what is the timing for circulation? At least 21 days before the meeting. It's similar to section 101, notice of meeting. Understood? For section 8 companies, 14 days. 14 days before meeting, yes, financial statement shall be circulated. And of course, the time period can be reduced with 95% of voting members, shareholder agrees. Here, for shorter consent, let me tell you, for shorter notice, just follow section 101 EGM shorter notice requirements. EGM shorter notice requirements. Getting it? Next one, mode of circulation. Electronic mode for dematerialized shareholders with registered emails or written consent, and physical copies for other companies or persons holding shares in material form, physical papers, physical documents. Next one, for listed companies must make documents available for inspection. Companies must make aforesaid documents available for inspection at registered office 21 days prior to the meeting. Alternatively, they can send a summary in form AOC 3 or AOC 3A. And if shareholder requests for full information, then circulate full information among the requested shareholders. Foreign subsidiaries audit is up to their countries where those foreign subsidiaries were incorporated. And yes, upload these unaudited accounts, but if they are not available in English language, then they need to be translated in English language. Certified translated copy should also be there. And for Nidhi companies, members are very huge in number. So, and members belongs to rural areas. Popularly, Nidhi companies are very much popular in rural areas. So for them, individual circulation is not required. Just attach them in the notice board of the company. So if members hold less than 1000 in face value or less than 1% of paid up share capital, for them individual circulation is not required. Just publish a notice in the local newspaper, intimation on the notice board, inspection allowed at the registered office. But if a member is holding 1000 rupees face value of securities or 1% paid up share capital, then individual circulation is required with respect to those members. Understood? So categorization of members, like rich, poor, for example. Here also 1000 face value or 1% paid up share capital members will get financial statements to their address. And a member holding less than 1000 face value or 1% of paid up share capital, for them individual circulation not required. So inspection registered office is available. So for that, make a advertisement make an advertisement in local newspaper. So inspection, who can inspect? Members, trustees of debenture holders. When and where? At registered office. When? During business hours. In case of default company, 25,000 penalty, defaulting officer 5,000 penalty. So clarifications and modifications ma, general meeting notice, yes, clarification. Financial statements may be circulated with a shorter notice, but for shorter notice, consent which is prescribed under section 101 with respect to EGM, EGM of a company with share capital, majority of members holding 95% of the paid up share capital entitled to vote. If it is a company without share capital, members holding or members having 95% of total voting power, only with these people consent, financial statements can be circulated with a shorter period, that means less than 21 days. Foreign subsidiaries, format should be as per Companies Act 2013. Deviations, in case of any deviations, they must be explained in a separate statement along with the reasons. That is all about 136. Now we are left with 137 and 138, internal audit. 137, filing of statements with registrar. Every company, including OPC, must file a copy of financial statements with ROC. And when to file, what to file. You can see here what to file: financial statements including CFS, required annexures, documents, loan audit report, board report. Next one, timeline. Within 30 days of AGM. Within 30 days of AGM, filing should be done. But for OPC, AGM is not applicable. So 180 days from the closure of financial year. And no need of AGM. If no AGM was conducted within due date of AGM, then within 30 days of AGM due date, file these financial statements as a provisional financial statements. Understood? Unadopted financial statements, or if AGM is not conducted, then file financial statements with ROC. ROC will consider them as unadopted financial statements, will consider them as provisional financial statements. Next, when AGM was conducted, when financial statements are adopted at adjourned meeting or original AGM, then file adopted financial statements with ROC, which ROC consider them as final financial statements. Forms to use, generally AOC 4 for standalone. For consolidated financial statements, AOC 4 CFS. And for NBFCs, AOC for NBFC, AOC for CFS, NBFC. Next one, CSR reporting shall also be done along with the financial statements filings. CSR filing is also there with ROC. Next, XBRL filing, very important to remember the companies to which XBRL filing is applicable. So, listed companies, its subsidiaries, or company meeting any of these criteria, paid up share capital 5 crores or more, turnover 100 crores or more, and companies which are preparing financial statements as per Ind AS, which is Ind AS, they need to follow XBRL. ROC filings should be done using extensible business reporting language, XBRL. Next one, special provisions. So foreign subsidiaries attach unaudited accounts with the declaration translated into English if needed. Unadopted provisionals, I told you, like, financial statements, if they are not adopted at AGM, then file provisional statements within 30 days of AGM. Mark them as provisional. Who will mark it? ROC will mark them as provisional financial statements. And in case of default of section 137, the punishment is for company 10,000 penalty, additional penalty of 100 per day in case of continuing default, up to 2 lakhs. For directors, 10,000 plus 100 per day, up to 50,000 rupees. Next one, 138, internal audit. Internal audit applicability is very important to understand. For listed companies, by default, internal audit is applicable. For unlisted public companies, any company, unlisted public company falling in these criteria, out of 4, any one satisfied, then internal audit is applicable. So criteria is preceding financial year paid up share capital 50 crores or more, preceding financial year turnover 200 crores or more, and any point during preceding financial year, any day, any time. If outstanding loans, debentures, borrowings, 100 crores or more, or outstanding deposits 25 crores or more, then internal audit is applicable. See, paid up share capital turnover, we will look at year closure, preceding financial year, closure date. But outstanding loans, outstanding deposits, we will observe at any point of time during the preceding financial year. So every year you need to check whether internal audit is applicable or not. This year applicable, next year may not be applicable, next year may be applicable, next year may not be applicable. So it all depends on preceding financial year statements with respect to unlisted public companies, private companies. For private companies, paid up share capital, deposits criteria will not apply. 2 and 3 criteria will apply for private companies. And what is the compliance timeline, sir? within 6 months of meeting the prescribed criteria. Suppose 31st March 2024, we came to know that our turnover is 250 crores. That's it. Internal audit is applicable. By 30th September 24, comply section 138. Getting my point, students? Next one, who can be appointed as an internal auditor? Maybe an employee or maybe an independent practitioner, CA, whether in practice or not, CMA, whether in practice or not, any other professional as decided by the board. Of course, internal auditor may be an employee of the company, may not be an employee. Suppose a company can have a internal audit in-house mechanism. In-house, that means employees will take care of internal audit, or they can outsource internal audit. There you can see independent professionals doing internal audit. Determination of scope or method, it is decided by audit committee if applicable, or board will decide the scope of internal audit after consulting internal auditor. And manner of the audit, audit shall be as per scope of the audit, functioning methodology and periodicity, quarterly, monthly, half-yearly, yearly. That's all about, decided by audit committee or board in consultation with internal auditor. And these provisions for IFSC applies only if AOA allows it. So privilege is there to IFSC companies. So with this quick revision, not detailed revision, quick revision of accounts of companies also completed. Let's continue our quick revision with chapter 10, audit and auditors, which is having a weightage of 8 marks in your examination. This is the lengthiest chapter, but I summarize this chapter into 10 pages. You can look into the material. Now I continue my revision with section 141, which talks about eligibility, qualifications and disqualifications of company auditor. See, who can be appointed as an auditor? Here we had two options. Option 1 is individual auditor. Option 2 is firm of auditors. In case of individual auditor, he must be a chartered accountant holding certificate of practice. In case of firm or LLP, majority of partners must be chartered accountants and must practice in India. Getting my point? Who shall sign? In case of a firm of auditors, who can sign audit report? The partner who is in practice, the partner who is a chartered accountant in practice shall sign the audit report. So this is all about qualifications. Now coming to disqualifications, important category. You can expect a question from disqualifications. Getting my point, students? So disqualifications very important. See, disqualifications, first one is body corporate. All body corporates except LLP are disqualified. That means LLP is qualified. Except LLP, all other body corporates are disqualified. Next one, officer of the company, employee of the company, disqualified. Partner of an officer, employee of an officer, partner of an employee, employee of an employee. All these 4 people are disqualified. Only reason, independence. So there should be no conflict of interest. Getting it? Next one, holding securities or interest. If it is a company with share capital, we use word securities. If it is a company without share capital, we use word interest. Now here 3 persons, self. For example, myself, we. I'm Mr. V, practicing chartered accountant. Myself, my relative, my partner. Here partner means business partner or professional partner, but not life partner. Life partner comes in relative. Life partner comes in relative. Getting it? So self, relative, partner holding securities in the company or group companies. So group companies, total 4 companies. C stands for company, A stands for associate company, S subsidiary company, H holding company, and subsidiary of holding company. So in all these companies, if my relative or my partner or myself holding a single security, disqualified. But relative, there is an exemption. Exemption is relative can hold securities up to face value of 1 lakh rupees. Face value. Here important point is face value. Getting it? Next one, indebtedness to the company or group exceeding 5 lakh rupees. So that means indebtedness up to 5 lakh rupee, no disqualification. Exceeding 5 lakh rupee, disqualification. Given a guarantee or security on behalf of a third person exceeding 1 lakh. So this is indirect indebtedness. Indirect indebtedness up to 1 lakh rupee, no disqualification. Exceeding 1 lakh rupee, disqualification. Getting it? Next one, business relationship. Here you can see total 6 companies. Company, associate company, subsidiary company, holding company, subsidiary of holding company, and subsidiary of associate company. So with these group companies, if you are having any business relationship, then you are disqualified. Of course, few exceptions are there. Those exceptions are professional services permitted under Companies Act or Chartered Accountants Act. Next one, if a business transaction is happening between a company and proposed auditor, but the transaction is happening at arm's length price, that means the price generally prevails in the market between unknown seller and unknown buyer. In the ordinary course of business, then also not disqualified. Actually, if you had a business relationship with these group companies, then you are disqualified from the, you are disqualified to the entire group. You cannot act as an auditor to any company in the group. But if you are falling in these two exceptions, then you are qualified. Next one, a relative of auditor cannot be a director or KMP. Suppose if your relative is a director or holding any KMP position in the company, then you are disqualified to act as an auditor of the company. Next one, yes, full-time employee elsewhere. That means, I'm employee in one company. Now I want to audit in another company. Full-time employee is disqualified. Next one, there is a ceiling limit on number of audits. Maximum I can accept audit engagements up to 20. But while counting this ceiling limit, while counting this 20 limit, one person company, dormant company, small company, private company with paid up share capital less than 100 crores. I'm using the word less than. It's not less than or equal to, less than 100 crores, provided that private company has not defaulted in 92 or 137. Then these four companies are excluded while counting ceiling limit of 20. Next one, fraud conviction. If any auditor is disqualified, if any auditor is convicted of fraud by court, then he is disqualified for 10 years. If such conviction is held, if such conviction happened in the tribunal, then disqualified for 5 years. Very important, ma. In court, if you are convicted, 10 years disqualification. In tribunal, if I was convicted, 5 years disqualification. Next one, prohibited services. As long as you are continuing as an auditor or at the time of appointment of auditor, yes, you should not provide these services which are prescribed in section 144. Suppose at the time of appointment, no disqualification, sir, but after appointment, subsequent to appointment, disqualification attracted. In that case, there arises vacancy in the audit office. But there is one exception. The exception is in case of relative holding securities face value exceeding 1 lakh rupee. A corrective action is to be taken within 60 days. So within 60 days of holding securities exceeding 1 lakh rupee face value, if corrective action is taken, then no need of vacation of audit office. You can continue as an auditor. Next, coming to the relative. Yes, relative includes father, stepfather, mother, stepmother, brother, stepbrother, sister, stepsister, son, stepson, son's wife, daughter, daughter's husband, members of HUF, husband or wife, simply spouse. Next one, what are the prohibited services? You can see prohibited services here, account keeping, bookkeeping services, internal audit, design and implementation of financial systems, actuarial services, advisory services, banking services, investment banking services, outsourced finance services, management services, any other prescribed services. So if you are rendering these services, then you are disqualified. Of course, when you withdraw from these services, at the time of appointment, if you withdraw from the services, then you are eligible to be appointed as an auditor. Getting it? And this prohibition applies to services rendered to company, holding company, subsidiary companies. So that means these services you should not provide to the company, proposed company, or its holding company, its subsidiary company. If you are not providing the services to these three companies, then you are eligible to act as an auditor in any one of these three companies. Getting it? Next one, audit committee and related provisions. First of all, audit committee, the role of audit committee is to ensure independence of the auditor. Auditor should be independent throughout the audit. So whether auditor is independent or not, anything or, which is affecting the independence of auditor, audit committee will remove such kind of obstacles. Audit committee ensures that auditor is acting independently. Now this audit committee, you will find, directors only. In audit committee also, you will find directors only. But this audit committee is not applicable for all companies. It is applicable only for listed companies, public companies meeting any one of the following conditions. So what are those conditions? Paid up capital 10 crores or more, turnover 100 crores or more, outstanding loans, borrowings, debentures, deposits 50 crores or more. In case of unlisted public company, if it is falling within these three, any one of these three criteria, then it is compulsory to have it should have a audit committee. Understood? And these limits we should check as per the preceding financial year audited balance sheet. Next one, role of audit committee, if constituted, it selects auditor. Majority of audit committee, majority of directors in audit committee must be independent directors. Getting it? Majority of the directors in audit committee must be independent directors. Next one, role of audit committee, if constituted, they select auditor based on the company size, requirements, experience. Based on the company size, requirements, and based on the experience and qualifications of the proposed auditor. And it will also consider any orders proceedings against the proposed auditor. And if voluntarily, voluntary audit committees, yes, voluntarily few companies can have audit committees. In that case, what is the consequence? I will tell you. Just listen, just wait. See, what is the role of audit committee? They select auditor, they make recommendation to the board of directors about their selection. And board of directors had two options, either to agree with audit committee or to go with another person, another auditor. So if board of directors have disagreed, then they refer back to the audit committee for revision. If disagreement persists, board of directors can still propose its choice of auditor with recorded reasons why they don't want audit committee selected person and why they want another person. And final decision lies with members. So members will take a decision, members will take a call. So who shall be appointed as an auditor, who will continue as an auditor. Now, composition of audit committee, you can see in audit committee at least 3 directors should be present, and majority of directors must be independent directors. So independent director is a director who is not connected to day-to-day affairs of the company. So he is independent. Simply, he is a non-executive director. He will not participate in day-to-day affairs of the company. Next one, members should understand financial statements. Members of audit committee, that means directors, should understand the financial statements. That means technicalities in the financial statements like Schedule 3, accounting standards, everything. Suppose, if a company is not required to have audit committee, but it constituted audit committee, in that case, then also audit committee can recommend auditors, but board of directors may or may not follow the recommendation. So this is the consequence where company is having audit committee on voluntary basis. So voluntary basis means, mandatory, it should have audit committee. Mandatory, it should have audit committee. Other than these cases, company can still have audit committee, but in that case, it's up to the board of directors whether to go with audit committee recommendation or not. That's it. Next one, selection of auditor completed. Now, appointment of auditor. So here, auditor, two types. First auditor, subsequent auditor. Again, auditor of non-government company, auditor of government company. You all know government company is a company in which at least 51% of paid up share capital held by CG, one or more state governments, combination of the above. And subsidiary to a government company is also a government company. Subsidiary to government company is also a government company. That last point is very important. Subsidiary to government company is also a government company. If you forget this point, you may end up with writing a wrong answer in the examination. Getting it? See, appointment of first auditor. Who is having authority to appoint first auditor? In case of non-government company, board of directors, and time limit 30 days from incorporation date. If board fails, then members appoint our first auditor within 90 days at EGM, and the first auditor tenure is, he will continue the office until the conclusion of first AGM. And appointment by, a first auditor appointed by managing director is invalid. This point is important from practical question point of view. Managing director appointed first auditor of a non-government company, valida, invalida? Invalid. Board had power to appoint first auditor. It's not single director. Now coming to government company, C&AG is having authority to appoint first auditor within 60 days of incorporation. If C&AG fails, then board of directors next 30 days. If board of directors also fails, then members within next 60 days at EGM. And the tenure is same. The tenure is same to the first auditor of non-government company. Here the first auditor of government company holds office till the conclusion of first AGM. And board of directors appointment is invalid. C&AG must appoint first auditor of the government company. Next one, appointment of subsequent auditor. Who is having authority to appoint subsequent auditor? In case of non-government company, members. In case of government company, C&AG. So what is the time limit for appointment of subsequent auditors? AGM. In case of non-government companies, AGM. At AGM, members appoint a subsequent auditor. Whereas government companies, C&AG appoints a subsequent auditor within 180 days from the commencement of the financial year. So 1st April, add 180 days. That is the timeline for appointment of subsequent auditor in case of government company. And tenure of the office, In case of non-government company, auditor shall hold audit office till the conclusion of his 6th AGM. But coming to government company, only 1 year. That means by next AGM, his tenure comes to an end. Next one, pre-appointment requirements. As you all know, before naming someone as an auditor, it is compulsory to get written consent from the proposed auditor. And a certificate of eligibility, no disqualifications, and within the ceiling limits. Yes, proposed auditor has to send this information, has to share this information with the audit committee or board of directors of the company. Declaration of pending proceedings against auditor, partner, or firm is also required. Next one, file notice of appointment. Once auditor is appointed, file notice of appointment with registrar within 15 days in form ADT1. So this is an intimation of appointment of auditor. What is the time limit? 15 days. What is the applicable form? Form ADT1. Additional notes, inform NFRA as per NFRA rules wherever applicable. As you all know, section 132, NFRA governs few companies. So if you are appointed as an auditor in those companies, yes, company is responsible to inform the same with NFRA. Next one, C&AG powers with respect to government company. C&AG within 60 days from the date of receipt of audit report, he is having a right to conduct supplementary audit or conduct test audit. Supplementary audit, if he is not sure with respect to few areas in the financial statements like, debtors balances, creditors balances, then he can ask for, he can call for a supplementary audit of debtors or creditors. So he can appoint a person, he can authorize a person, or he himself can do supplementary audit. And C&AG can comment upon or supplement the existing audit report. So supplements must be sent to all the members as per section 136. As per section 136, all the members of the company, directors, auditors, yes or no. So trustee of debenture holders, they are entitled to receive the copies of financial statements. So now send all these information, comments or supplementary audit report to the people. Next one, supplementary audit report shall be presented before AGM along with the audit report. Next one, test audit. It's a overall audit of controls, test of controls, test of details. So C&AG can order a test audit for companies under section 139 subsection 5, 139 subsection 7. That means for government companies. Next one, test audit must comply with section 19A of C&AG Powers Conditions of Service Act 1971. Normal point ma. Next one, casual vacancy. Casual vacancy. So this is a vacancy arised before expiry of auditor's term. The reason may be death, disqualification, resignation. So if it is a death, disqualification, no problem. But if it is a resignation case, in this case, first of all, let me tell you, in case of casual vacancy, in case of non-government company, board of directors within 30 days of casual vacancy appoints another person, another auditor, another chartered accountant, another practicing chartered accountant as company auditor. But if it is a reason of resignation, the vacancy is because of resignation, then appointment by board of directors shall be ratified by the members at a general meeting within 3 months. Within 3 months of board appointment, yes, ratification should happen. And in case of government company, C&AG within 30 days of vacancy, appoints a company auditor. If C&AG fails, then board of directors within next 30 days. But in both the cases, non-government company, government company, the auditor so appointed shall continue to hold the office till the conclusion of next AGM. It's not 6th AGM, just by next AGM, the tenure comes to an end. So you may be asked a question like, original auditor tenure is 3 years pending. So can an auditor who was appointed to fill up the casual vacancy continue for a period of 3 years? That is the original tenure of the company auditor? No, the answer is no. So here, any person who was appointed to fill the casual vacancy can continue to hold the office till the conclusion of next AGM. Everyone. Next one, auditor resignation. See, auditor can resign from audit office. There is no compulsion that auditor should audit the financial statement, should issue an audit report. If he is not okay with the management representations, he can resign. He can come out of the audit office. But in case of opting resignation option, he is having a duty to communicate with authorities. If you are an auditor of a government company, you should communicate with company, registrar and C&AG. In case of non-government company, you must communicate with company and registrar within how many days? Within 30 days of resignation. And what is applicable form? ADT3. failure to communicate with these authorities attracts punishment. What is the punishment? 50,000 rupees or remuneration, whichever is lower, plus continuing failure, additional fine of 500 rupees, maximum 2 lakh rupees, maximum 2 lakh rupees. So this is the punishment in case of default in communication with authorities. Everyone. So next point, rotation of auditors. Rotation of auditors is not applicable to all companies. It is applicable only to few companies. So what are those companies? Let's see. All listed companies, rotation of auditor is applicable. Unlisted public limited company, either with paid up share capital 10 crores or borrowings 50 crores or more. In case of private limited companies, only one limit, 50 crores. Paid up share capital 50 crores, borrowings 50 crores or more. Then rotation of auditors is applicable. So three companies, listed, unlisted public company, private company. Listed company without any limits. Unlisted company, either paid up share capital 10 crores or more, borrowings 50 crores or more. Private limited company, paid up share capital 50 crores or more, borrowings 50 crores or more. And manner of rotation. Rotation applies to the specified categories of the companies, as I told you just now. And rotation will not apply to OBC, small companies, government companies. As you all know the reason, in case of government companies, C&AG appoints auditor for every year. Auditor will be appointed by C&AG every year. So the tenure of the government company auditor ends with the conclusion of next AGM. Whereas if you look at the non-government companies, the tenure is, in case of his first AGM, if he was appointed, he can continue to hold his office till the conclusion of sixth AGM. Getting it? So next one, rotation period. In case of completion of the tenure, once an individual auditor was appointed, he can act as an auditor for one term of 5 consecutive years. In case of audit firm, partnership firm or LLP, 2 terms of 5 consecutive years can be appointed as an auditor. Once this tenure is completed, then cooling period of 5 years is there. Cooling period means, next 5 years, this individual or firm of auditors can't be appointed as company auditors to the same company. Getting it? Next one, audit committee's role. The audit committee shall recommend a new auditor after the term of current auditor ends. Once current auditor tenure ends, the audit committee shall recommend a new auditor. Next one, there should be no common partner between, incoming audit firm and outgoing audit firm. That means they should not have common connection, like common partner, common owners, common network. Internal rotation, the members can resolve internal rotation of the auditor partner team joint audit. That means, one term of 5 years, one term of 5 consecutive years appointed. For example, the firm is ABC and Co, where A, B, C are practicing chartered accountants. Now members of company can ask, so first year Mr. A will do audit, second year B will do audit, third year C will do audit. This is like internal rotation. Same audit firm, but internally partners getting rotated with respect to audit of company. And the period of appointment before commencement of this act is also included for calculating the term. Suppose under old Companies Act, I already completed 2 years tenure. Now, I'll be left with 3 years. As an individual, I'll be left with only 3 years because 5 consecutive years, come on, a company can have an auditor for 5 consecutive years. The individual can be appointed as an auditor for how many years, one term of 5 consecutive years. Already 2 years completed under old Companies Act. Now under new Companies Act, I'll be left with only 3 years tenure. Procedure for removal of the auditor. Just simply remember this equation: board resolution plus central government approval plus special resolution. So don't change this equation. In recent examinations, I have seen that question was asked like this: board resolution plus special resolution. Now application filed with CG for CG's approval for removal of the auditor. So removal of auditor, valid or invalid? Invalid. First you need to get central government approval, then only you need to get a members approval. Don't change the equation. Board plus CG plus special resolution. Understood? So once board resolution has been passed, within 30 days of board resolution, file an application with CG. And once CG gives approval, within 60 days of CG approval, conduct a general meeting and pass special resolution for auditor removal. And in case of IFSC companies, after filing an application with CG, wait for 60 days. If there is no reply from central government, then it is deemed that central government approved the application and you can proceed with members approval for removal of the auditor. IFSC companies privilege is there. No need to wait for central government approval for longer duration. Just 60 days wait. Within 60 days, if there is no reply from central government, you can assume that central government approved for removal of the auditor. Next one, procedure for removal of auditor by the tribunal. So tribunal, either on its suo motu basis or an application filed by CG or an application filed by any person, tribunal can remove the auditor on the grounds of fraudulent action by the auditor, or central government filed an application that proving and tribunal is also satisfied that change of auditor is compulsory. Then tribunal will order the removal of auditor within 15 days. CG may appoint a new auditor in their place. Next one, prohibition on further appointments. If once auditor was convicted under any fraud or offenses, once auditor is convicted by tribunal, the next 5 years he is disqualified. If such conviction happened in the court, then he is disqualified for the next 10 years. Same point I discussed with you under disqualifications also. Court conviction 10 years, tribunal conviction 5 years. Next one, auditor rights and duties. Coming to the rights, he is having unlimited access to the books of accounts. With respect to consolidated financial statements, he can also access to the subsidiaries associate books of accounts, and access to other records like board minutes, MIS reports also permissible. Next one, right to obtain information and explanation. So yes, from third parties like debtors, creditors, so he can ask balance confirmation. He can request for balance confirmation and he can get that information. Right to receive notices and right to attend general meeting. It's not only right but also duty. He is having a duty to attend general meeting also. A right to lien. So yes, once auditor rendered the services and for which audit remuneration is pending, so whatever books of accounts he is lawfully holding, he is possessing those books lawfully, then he can exercise lien right. Understood? Until his remuneration is paid. But practically this will not work, because as per section 128, books of accounts shall be maintained at registered office. So how books of accounts will be transferred to auditor office? So practically this won't work, but as per Companies Act I am telling you. So he can retain the books for non-payment of his fees. Right to report to the members. Yes, he is having a right to report to the members on the financial statements examined. This is not only right, this is also a duty to report. Few rights are also duties to the auditor. Yes, how sir? Because as an auditor, he is having a right, and he is also having a duty to conduct audit, duty to report. And in report he must specify that he audited financial statements of the company, which are combined with balance sheet, profit and loss account, cash flow statement. Understood? And he must express opinion whether accounts give a true and fair view of company affairs or not. A report must consider provisions of the Companies Act as well as standards on auditing, accounting standards. And auditor must state the reasons for any qualifications. Just qualifying his opinion alone is not sufficient. Qualifying his opinion alone is not sufficient. He should state the reasons why he is qualifying his opinion. And he should also include the matters relating to whether he obtained all necessary informations or explanations or not, whether proper books of accounts are maintained or not, whether financial statements comply with accounting standards or not, observations on financial transactions affecting company functioning, whether any director is disqualified under section 164 or not, whether adequate internal financial controls are in place or not, comments on the matters such as pending litigations, outstanding litigations, long-term contract provisions, and with respect to declared dividends, and verification of accounting software features, audit trail complaints. So he need to report on all these matters. Next one, duty to sign audit report. Of course, the person, the chartered accountant in practice who conducted audit of financial statements must sign the audit report, and he should comply standards on auditing throughout the audit. And he is having a duty to attend a general meeting. Actually, members are having right to attend general meeting. Now, in addition to members, auditor is also having a right to attend general meeting. At the same time, it is his duty to attend general meetings. Next one, auditor duties in relation to fraud reporting. fraud. So here, many students confused with respect to amounts. Fraud greater than or equal to 1 crore, one category, less than 1 crore, another category. If it is greater than or equal to 1 crore, yes, here communication with CG is compulsory. If it is less than 1 crore, no need to communicate with CG, just communication with board of directors or communication with audit committee is sufficient. Getting it? So the limit is greater than or equal to 1 crore. You remember, don't apply less than or equal to 1 crore. It's greater than or equal to 1 crore, communication with CG. Less than 1 crore, communication with board of directors or audit committee, as the case may be. Now report to the fraud, report the fraud to the board audit committee within 2 days of finding out the fraud, and wait for 45 days. Board has to respond to the auditor report within 45 days. So wait for 45 days. If there is no reply within 45 days of knowledge of fraud, report to the CG with the details, and report must include auditor's contact details too, membership number, and sign with a seal. The report should be in form ADT4 format. And suppose there is a response from the management, then within 15 days of receiving the response, observations from the board or audit committee, file ADT4 with central government. Getting it? So 45 days time limit is there for responding, for board of directors replies. If no replies, then file ADT4 with central government. Suppose if there is a reply from board of directors or audit committee, now along with the observations, the replies of the board, the replies of the audit committee shall also be attached and shall be submitted to CG within 15 days of receiving the replies. If fraud amount is less than 1 crore, same thing will prevail, but communication with CG will not happen. So report the fraud within 2 days, including the nature, approximate amount, and parties involved. And board of directors have to make a disclosure in the board report stating that nature of the fraud, amount involved in the fraud, parties involved in the fraud, and the remedial actions taken by the company. Next one, other related provisions. Yes, of course, here auditor is reporting to the central government, so he is overriding confidentiality characteristic. He is overriding confidentiality character. So is it a good or bad, sir? If it is done in good faith, good only. So application to other auditors. This provision 143.12 reporting of frauds, this is applicable not only to the company auditors but also to the cost auditors, secretarial auditors. If company auditor, cost auditor, secretarial auditor fails to comply with section 143 subsection 12, then they get punishment. What is the punishment? If you're an auditor of listed company, 5 lakhs punishment. If you're an auditor for other than listed companies, then 1 lakh is the punishment. Everyone. Next, branch auditor appointment. So who can be a branch auditor? Company auditor can be branch auditor. If it is not possible, then any other chartered accountant holding certificate of practice can be appointed as a branch auditor. And for branches outside India, you can have another option, that is, other person qualified to act as an auditor in respect to country. Suppose you are having a branch office in USA. So in USA, we are having CPA. So CPA can be appointed as a branch auditor. And who appoints branch auditor? Generally members. However, members can delegate the power to board of directors. See, with respect to principal auditor, only members can appoint principal auditor. But with respect to branch auditor, members can appoint a branch auditor, or members can delegate this power to board of directors. Next one, reporting requirements of branch auditor. The branch auditor must prepare a report on the accounts of branch office. The branch auditor submits the report to the company's auditor, and reporting requirements under section 143, 1, 3, 11 and 12 are applicable to branch auditors. Suppose branch auditor found a fraud. Fraud amount is, for example, greater than or equal to 1 crore. Now, branch auditor has to make a communication with a board of directors or audit committee within 2 days. Once he received reply from them, within 15 days of receiving reply, he has to communicate that matter with CJ. That means, whatever 143 subsection 12 I discussed with you with respect to company auditor, cost auditor, secretarial auditor, same will apply to branch auditor also. Next one, coming to the last section of audit and auditors, cost audit, very, 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 underrated topic. Chance is there. So far, a question was not tested on cost audit, but nevertheless, you can expect ICAI thumb line is very simple. ICAI line is very simple. Expect from unexpected areas. So maybe if question comes from cost audit, you should not be panic. Understood? See, first of all, applicability of cost records is important. Applicability of cost records, if two conditions are satisfied, then cost records applicability prevails. What are the two conditions? First one, company is engaged in production or providing services. Simply, company is not a trading concern. Company is a manufacturing concern or a service concern, providing services. And the turnover, overall turnover is 35 crores or more in the preceding financial year. If these two conditions are satisfied, then cost records are mandatory. And we had exceptions, micro small enterprises, even though they satisfy these conditions, they are exempted from maintenance of cost records. Next one, here classification of companies. Companies are classified into two sectors: regulated sectors, non-regulated sectors. So this is, this classification is relevant for applicability of cost audit. Applicability of cost audit. Let's see. Cost records shall be maintained in form CRA 1. Next one, records should track unit cost, production cost, margin for each product activity on a regular basis. Understood? Ignore CARO reporting, just ignore CARO reporting, not relevant. Next one, cost audit under section 148, applicability. Regulated sectors, here maintenance of cost records, first condition, production or providing services. Second condition, overall turnover 35 crores. Overall turnover 35 crores. But coming to cost audit, for regulated sectors, cost audit is applicable if the turnover, overall turnover is 50 crores and turnover from regulated sectors is 25 crores. Overall turnover 50 crores. Overall turnover 50 crores. If overall turnover is 50 crores, that means, 35 crores condition already satisfied. That means cost records maintenance is required. Next one, regulated sectors turnover should be 25 crores or more. These two conditions satisfied, then audit of regulated sector is allowed, applied, applicable. Non-regulated sectors, coming to non-regulated sectors, overall turnover should be greater than or equal to 100 crores and, turnover from regulated sector, non-regulated sector, the turnover from regulated sector and non-regulated sector. Here also, same thing. Regulated sector, non-regulated sector should be greater than or equal to 35 crores. When both the conditions are satisfied, then only audit is applicable to both regulated sector as well as non-regulated sectors. Next one, non-applicability. For one more point, for better clarity of this point, just go through this study material. We gave you a table. We already provided a table. Just go through the table. So very important point, but majority of the students will not understand this point. Just go through the table which is there in this study material. As I told you many times, this is a quick revision. This is not a detailed revision. So the objective of this revision is to remember or to recap the important points. So during revision, you won't think about the logic. At the time of preparation, first time preparation, second time preparation, you think about the logic. But during revision, it's like, quick revision capsule. Getting it? Non-applicability, in case companies with a 75% greater, exceeding 75% revenue from exports are operating in this CIS, companies operating in this CIS, or captive electricity generation, captive consumption. So company falling in this category, cost audit is exempted. Next one, appointment of cost auditor. Who appoints cost auditor? Board of directors. But remuneration fixation is taken care by board of directors, later ratified by the members. Okay. In case of casual vacancy must be filled within 30 days of vacancy by the board of directors. Removal of cost auditor, board resolution is required for removal, and procedure for submission of the cost audit report. Cost audit report shall be submitted within 180 days from the closure of financial year along with any qualifications. So submit one copy of report to the central government, and if central government asks for any replies, any responses, yes, it is the duty of company, directors, management to respond to the central government queries. And cost auditor is also having same duty to report frauds. Next one, appointment of auditor, appointment of cost auditor. Appointment shall happen within 180 days of the completion of within the 180 days of commencement of financial year. Within 180 days of commencement of financial year, and within the same time limit, 180 days of commencement of financial year, yes, communication about appointment of cost auditor should happen. Suppose auditor, cost auditor was appointed in the month of May, then within 30 days of appointment, communicate the same with CG. Suppose, within 180 days, suppose in the month of September In the month of September, cost auditor was appointed. The same month, you communicate about appointment of cost auditor with CG. That means, the time limit is commencement of financial year. From here onwards, 180 days time limit is there for communication, for appointment, appointment as well as communication with CG. Understood? Within 180 days, appointment communication should complete. So extra time period is not given for communication with CG. That is a point. Okay. So with this, audit and auditors also completed. And let's continue quick revision with chapter 11, companies incorporated outside India, which is having a weightage of minimum 6 marks in your examination. Simple chapter, simplest chapter in the Companies Act. Simplest chapter, trust me. So by reading this document, this is of some 7 pages, 7 pages document. Reading this 7 pages, trust me, you can score easily 6 marks. So foreign company definition. First of all, foreign company means a company which is incorporated outside India but having place of business in India and conducts business activity in India. So when these 3 conditions are satisfied, it becomes a foreign company. Now coming to business in India, it can be either physical business, physical mode of business, or it can be electronic mode of business. Okay. Next one. Simply, board of directors of a foreign company gathering in India alone is not sufficient. Some business activity should be there. At least maintenance of registers, records, compulsory. Electronic mode, we had examples, just go through these examples. But this point you need to remember, in case of electronic based offering of securities, subscription listing in IFSC as set up under section 18 of SEZ Act 2005 shall not be considered as electronic mode. This point is important. This is covered in exceptions, exclusion activities. So chance is there. Question coming on this point, chance is there. Okay. Logic, I won't tell you in quick revision. If you want logic, just go with detailed revision. Detailed revision is already available in our channel. You can watch the detailed revision lecture. Detailed revision lecture is of approximately, let me tell you the tenure, 12 hours, 4 hours, 8 hours. So 24 hours detailed revision is available already on our YouTube channels. This is a quick revision. The length of this quick revision is approximately some 2 plus 4 plus another 4, some 10 to 11 hours. So 10 to 11 hours quick revision I'm conducting just for 10 to 11 hours only. So this is a quick revision, not detailed revision. Once again, I'm telling you. See, exception point, just remember the point, any electronic based services regarding offering of securities, subscription, listing in IFSC centers, only in IFSC centers will not qualify as electronic mode of business operations in India. Next one, sometimes few foreign companies are deemed to be Indian companies. When the point is, when this company, foreign company, company incorporated outside India, which is carrying business in India, in that company, 50% of paid up share capital or more than 50% of paid up share capital. In paid up share capital, you may find equity, you may find preference, or you may find a combination. But 50% of paid up capital held by one or more Indian citizens. I'm not talking about residents, I'm talking about Indian citizens, one or more Indian body corporates, or combination of the above, then that foreign company, even though it is a foreign company, as per this Companies Act, we assume it as Indian company. Accordingly, we will apply all the provisions of Companies Act to these companies. Next one. So if a foreign company, if company incorporated outside India wants to set up a business in India, then within 30 days of establishing place of business in India, they should submit following documents. One is constitutional documents. Next one, address particulars of foreign company outside India and the list of directors, secretary with prescribed details. So those details you can see here: name, farmer name, father name, birth date, residential proof, nationality, passport details, PAN, occupation, directorship, secretary, email ID. So these information you have to provide along with the documents. These information of the directors, secretaries you need to provide. Additional documents, authorized persons address for service of the documents in India, full address of principal place of business in India, details of past business openings. In past, if you are already opened any branch office in India and if you close that branch office, furnish those particulars. Declaration regarding directors, representatives qualifications. See, on this point, one MCQ is there. Declaration is required only from directors as well as authorized representative. It's not from secretary. From secretary, no need to expect all the declaration regarding disqualifications. Okay. Next one, other prescribed information. Next one, application form and time for submission. I told you within 30 days you have to submit these documents with ROC within 30 days of establishment of place of business in India, and the applicable form is FC1. Okay. Next one, FEMA approval. Under FEMA, RBI approval is required under FEMA. Next one, the documents must be delivered to the registrar. Which registrars are? Registrar having jurisdiction over New Delhi, and the submission must be accompanied by the prescribed fees. If foreign company ceases to have a place of business in India, then notice must be given to registrar. Then only the obligations with respect to submission of annual documents with ROC comes to an end. Or else company is having an obligation to submit documents annually, like annual returns, financial statements. Okay. Existing companies means, existing foreign companies before commencement of Companies Act 2013. So before commencement of Companies Act 2013, any foreign company came to India must comply with the delivery of documents under Companies Act 1956 if they have not already done so. Next one, any changes in the aforesaid documents. Yes, you have to intimate ROC in form FC2 within 30 days of alterations. Next one, accounts of foreign companies, same as Schedule 3 is applicable, accounting standards are applicable, but only with respect to operations in India. I'm not talking about that parent company financial statements. I'm just talking about branch office operations in India. With respect to these operations, yes, financial statements shall be prepared, presented in Schedule 3. So Chapter 9, accounts of companies will apply, and audit also applicable. And financial year, by default, financial year ends on 31st March. By default, financial year ends on 31st March. But if you want to follow different financial year, okay, go and get approval from CG. Next one, if parent company financial statements are not available in English, then a certified English translation must be attached with respect to parent company financial statements. Next, central government may exempt or modify the application of certain requirements for specific foreign companies or class of foreign companies through notifications. It's all about powers of central government for granting exemptions or making modifications. And they need to provide the list of business places in India in form FC3 along with that prescribed fees. Next one, additional attachments with financial statements. You need to remember these additional attachments. Statement of related party transactions, repatriation of profits, transfer of funds, any other particulars as prescribed by the Company Rules 2014. So these 4 statements should be attached along with financial statements of the branch. And time limit for filing these documents, within 6 months of the closure of financial year. Actually, for Indian companies, it's 30 days of AGM, but here AGM is not compulsory for these foreign companies, right? Because companies incorporated outside India, not as per our Indian Companies Act, it is incorporated outside India as per foreign country company laws. So within 6 months of closure of financial year, file the documents with ROC. Of course, ROC can grant extension up to 3 months. Next one, audit requirement. Yes, with respect to branch operations, audit requirement is always applicable. Audit requirement with respect to branch operations, yes. Who can be auditor? Any individual practicing chartered accountant or firm of practicing chartered accountants, including LLP. Next one, applicability of Indian laws. Chapter 10 will apply as if it is an Indian company. I'm not telling about, on consolidated basis. I'm telling about only branch operations. For branch operations, Chapter 10 will apply. Next one, display of name. Here you need to remember, name shall be displayed in 2 languages. One is, English language. The other one is vernacular language. English language, vernacular. That means local language. So name shall be displayed at the entrance of each and every office, each and every business place in India. Next one, with respect to official publications, yes, English language alone is sufficient. Only English language is sufficient with respect to invoices, letters, billheads, papers, notices, etc. Next requirement, if a company members liability, nature of members liability is limited, then mention the point clearly that the nature of members liability is limited, where both on the notice board as well as on all official publications. Both in, In case of official publications, English language. Very simple, very simple to remember. I'm talking about name board to be displayed at the entrance of each and every business place in India. And this second one is official publications. So with respect to official publications, English language alone is sufficient. English language alone is sufficient. With respect to name board, English plus local language. English language plus local language. 2 languages are required. Everyone. So this is an extra point. First of all, what shall be displayed on the name board? The name of the company and country of incorporation. Along with these two things, if the nature of members liability is limited, then also disclose limited liability. Service on foreign company. Service on foreign company. So just next point. Look at the next point. Service on foreign company. Any document to be served on foreign company, it is sufficient if the document is served to the authorized person. So any document or notice to be served on a foreign company must be addressed to the person, authorized person whose name and address have been submitted to the registrar. And the document is deemed to be sufficiently served if it is left at or sent by the post to the address provided to the registrar. That is, a business premises address in India. So no need to serve documents outside India, or it can be sent by electronic mode to the registered email address. Next one, 384 and 385. It is all about applicability of other sections to the foreign companies. Like, section 71 is applicable with respect to debentures of foreign companies. Annual returns, section 92 will apply. But under section 92, annual return form is MGT7 or MGT7A. But here the form is FC4. And the time limit for filing annual return is 60 days from the conclusion of AGM. But here it is 60 days of closure of financial year. Understood? So form is different. 60 days, okay, but there 60 days of AGM, but here 60 days of closure of financial year. Next one, CSR requirements also applicable to foreign companies. Next one, books of accounts, same, receipts and payments, sales and purchases. Next one, assets and liabilities. So these registers should be maintained on accrual basis, double entry system, similar to Indian companies books of accounts. Charges, chapter 6 will apply. Registration of charges will apply. Inspection inquiry, chapter 14 will apply as if it is an Indian company. And fees for the document registration. Every document you register with ROC, it should be accompanied with prescribed fees. And this fees will be prescribed as per the company registration officers and fees rules 2014. So next one, prospectus. Issue of prospectus by a foreign company or by a person on behalf of foreign company. Understood? So every prospectus to be issued to the public, it must be dated and signed before issuing, circulating or distributing in India, and it must include the following particulars, constitutional documents, incorporation enactments, addresses in India for inspection of these documents, date and country of its inspection, principal office address in India if established. Of course, if company which has completed 2 years of tenure since incorporation, constitutional documents, exhibition, inspection of constitutional documents not required. Waiver of compliance, any condition in the prospectus, waiving compliance with respect to section 387 is void. So waiver of compliance, if you find waiver of compliance in prospectus, that particular condition becomes void. And form of application shall be always attached with abridged prospectus. Security application form shall be always attached with abridged prospectus. And forms issued for bona fide underwriting invitations are exempted. That means for them, issue of application form along with abridged prospectus is not required. So any invitations to the underwriters, prospectus is not required. Next one, prospectus not required for securities which are offered to the existing persons, existing members, existing debenture holders, or if securities are uniform in all respects with previously issued or listed securities. Same point is there in prospectus chapter also. For existing members, if you are offering securities, prospectus not required. Next one, if securities offered or belongs to the existing class which was previously issued and they were dealt on recognized stock exchanges, then subsequent issue of same class of securities doesn't require prospectus. Additional liability, section 387 does not limit liability under the other laws or Companies Act 2013. In case of misstatements, punishment will apply. That's what. Expert consent, if you want to include expert report, first of all you need to take a consent from expert. Only with expert consent you can include expert statement in the prospectus, and that consent must not be withdrawn before delivery of prospectus for registration. And section 33, that is application form attached with abridged prospectus. Section 40, listing of securities on the recognized stock exchanges, these provisions shall apply. Next one, inclusion of statements. Statements are deemed included if referenced in any attached report or memorandum. So if you are giving any reference to the documents in the prospectus, those statements, those documents shall also be attached to the prospectus. And registration of prospectus, first deliver a copy to the ROC, which should be signed by a chairperson who got authorized by the board, or two directors approved by the resolution and signed by the chairperson and two directors. Everyone. And next one, prospectus must state on its face that it has been delivered for the registration. So disclosure requirements. Next one, attachments. Documents to be attached, expert consent. First you include expert consent, then you can include expert statement. Next one, contracts for appointing MD or managers. Material contracts that are not in ordinary course of business executed within the last 2 years. See, on this point also we had one MCQ. So all material contracts executed within last 2 years, and all contracts for appointing managing director, manager, these documents shall be available for inspection. These documents shall be attached. Underwriting agreements. Next one, power of attorney if signed by authorized agent. Next one, section 390 is all about IDR. 41 speaks about GDR. 390 talks about IDR. GDR, issued outside India. IDR issued in India. GDR issued by depository participant outside India. IDR issued by depository participant in India. GDRs are issued on behalf of Indian companies. IDRs are issued on behalf of foreign companies. The procedure is same. Central definition of IDR, a depository receipt created by domestic depository in India, authorizing by a foreign company issuing such receipts. And central government is having power to establish rules with respect to offer of IDRs, disclosures in prospectus, dealing in depository mode, sale, transfer, transmission of IDRs by a foreign company, regardless of its place of business in India. Next one, conditions for issuing of IDRs. What are the conditions? Yes, comply with SEBI, RBI, Company Registration of Foreign Company Rules 2014. Next one, compromises, arrangements, amalgamation. Yes, this is also applicable to foreign companies. So here, merger may happen with, Indian company with foreign company, or foreign company with Indian company. That means, Indian company can acquire foreign company, or foreign company can acquire Indian company. All these things shall happen as per the rules framed by CG, and CG will make rules in consultation with RBI. Approval for cross-border mergers. Just now I told you, right? So merger of Indian company with foreign company, or vice versa. So prior approval of RBI is required. Terms of merger scheme. Next one, payment of the consideration. Yes, consideration can be paid either in cash or by issue of depository receipts, or combination of cash and depository receipts. So here, foreign company includes company incorporated outside India, whether it is having a place of business in India or not. As you all know, generally foreign company means incorporated outside India plus place of business in India. But only for this section, only for the purpose of this section, here foreign company includes a company incorporated outside India, whether it is having place of business in India or not. Next one, yes, applicability of 34 to 36. 34 criminal liability, 35 civil liability, 36 punishment for fraudulently inducing investments. So same punishments will also apply to the foreign companies. And punishment for contravention of this chapter, suppose you fail to file the documents within 30 days of establishment of business, or suppose name board is not displayed, or official publications are not containing the prescribed particulars, then fine of 1 lakh to 3 lakhs. And for continuing offenses, for continuing failures, additional penalty of 50,000 per day. With respect to defaulting officers, 25,000 to 5 lakhs is the punishment. So this punishment is for company, and this punishment is for defaulting officers. Next one, effect of non-compliance on validity of the contracts. Of course, contravention of this chapter will not affect the validity of the contracts entered by foreign company. But the problem is foreign company cannot enforce its rights. However, foreign company is having a duties. Foreign company is bound by the duties in the contracts, but foreign companies cannot exercise rights they got in the contracts until and unless they comply with the provisions of this chapter. Once they comply with the provisions of this chapter, they can exercise rights and they're also bound by the duties. Next one, unregistered use. If a person uses the name of foreign company without proper registration, they are liable for investigation under section 210. Legal action can be taken based on the investigation findings. Next one, powers of the central government. Central government is having power to exempt specific class or classes of foreign companies from the compliances of this chapter. Understood? The exemptions cover requirements related to offering securities, requirements related to the prospectus, and the exemptions are applicable to IFSC established under section 18 of CESA 2005. Clear? So as I told you, I compiled all the material points in a simple notes. So these notes and this video lecture is available to you. Clear? So I wish you all the best for your upcoming exams.